be that given that we have this productivity-enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
It doesn't look like we've got a major issue with the economy at the moment. The economy has been relatively resilient.
Central banks have carved out in the last 6 to 9 months a focus on core inflation.
2024 should be a better year for earnings with the market.
We are seeing inflation coming back down towards where the Fed would like it to be.
In the end, higher for longer means there's going to be further tightening here in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The Fed decision a little bit later on this afternoon. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Bramo just stepped off. She's going to be back a little bit later. In your equity market on the S&P 500, we're positive here by 0.2%. A lift to the equity market, TK. Hours away from Chairman Powell, that press conference, and all those lovely forecasts you look forward to, including that dot plot.
The dot plot, can't wait to see that, Jewel. What I'm going to look at is the dot plot that is the voice of the Standard & Poor's 500. John, rounded up 4,500. It's showing a resiliency. It's an equity market. Big amount of money that's saying they believe in the Fed, they're going to get the job done, and they need to be in equities. And you wonder at the margin, like Savita Subramanian
She's
today,
on board.
Going on board, and others, Ben Laidler with that optimism, Anastasia Amoroso with her optimism, etc. That's the Fed story today. The stock market likes what it sees.
If Savita goes to 4,600 from 4,300 over at Bank of America, I think we should talk about Max Kentner earlier on this week.
Yes.
Tom, just yesterday, Max saying people are too focused on what's going wrong. He wants to focus on what could go right next year relative to very downbeat expectations around China and around Europe.
And we just heard from Bruce Kasman some enthusiasm there about China. You know, he gave a typical J.P. Morgan, hedged it out. He's going to blame it on Ferroli if he's wrong. We understand that. But the bottom line is there's an enthusiasm here away from country-to-country domestic politics. We'll talk the UK politics on ESG here down the road. We don't need to do it now, but it's a ferment.
Sure.
It's a positive ferment here into these meetings.
If you are just joining us on Bloomberg Radio and you missed the conversation with Bruce Kasman over at JP Morgan, it's worth going back over. Bruce ultimately is on the high for longer page. How he referenced the dot plot and the projections over at the Federal Reserve, he used this word aspirational. He said it was aspirational, Tom, to look out next year to expect inflation to come in without too much damage to the labour market. Yeah. That's a man who does not believe that we can get inflation back to target, down towards 2%, without real pain in the labour market. Have we made progress on that so-called rebalancing in the labour market? Yes. Have we made sufficient progress? Bruce says no.
We've lost perspective of a fully employed America. The answer is we're at 4%. Bruce Kasman said he doesn't think we go above 4%. I have no wisdom on that other than to say that's the oddity of this cycle, and that's what the Fed has to deal with, is their dual mandate has become a single mandate. They're very ECB-ish.
Very ECB-ish.
They're ECB-ish, looking at rates, inflation. Oh, yeah, jobs, that's fine.
ECB last week, tomorrow the Bank of England, Friday, the BOJ. Let's get to the price action. Your equity market on the S&P 500 shaping up as follows on the S&P. We are positive here by 0.2%. Yields are coming in just a little bit, down about 2 basis points on a 10-year, 4.3407. In foreign exchange, the euro 107.03, sterling weaker against the dollar 123.64. A soft inflation print out of the UK that we can discuss, Tom, a little bit later.
Yeah, I would do that a little bit later. But the answer to me, you know, as we dive into the brief here, John, is there's disinflationary tendencies out there. People are like, yeah, I don't really care about it. Yeah, they're rationalizing disinflation, and it's in the air. Paul Krugman's essay in the New York Times, I think, really captured it.
Let's get to the morning brief for you. Coming up a little bit later, 2 p.m. Eastern Time,
we'll
FOMC decision followed by Fed Chair Jay Powell giving that news conference. Plenty of questions, I'm sure, about the projections they'll release in the SCP a little bit later. 2 speeches to look out for, 2 speakers off Wall Street. The Bank of America CFO, Alistair Borthwick, speaks at 7:15 Eastern Time, so about 10 minutes from now, at the Bank of America Financial CEO Conference. And this one here, JP Morgan CEO Jamie Dimon speaks at the Detroit Economic Club at 1 p.m., given the tension of this labour market, Tom, is in Detroit right now.
Secretary Dimon will be there. and we didn't talk about this in the last hour, but we're going to stop the show right now and talk about this. There are many people out there that wish that Mr. Dimon would migrate, as Mellon did, down to Washington to be bankerly. Can you do that in this time and this day?
Treasury Secretary?
Yeah, I don't know. But he's there in the crucible today of the American labor movement. It's extremely well done.
Shall we reflect on what UAW said yesterday?
We should. I don't know if they'll be at the lunch,
Every
but hey.
fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers.
I'm glad you brought that up. That was quite a statement.
It was a strong and powerful one, yeah.
And that sets up this tension of Wall Street, Main Street that Speaker Pelosi highlighted, many others as well. And I just don't think it's a small matter that a Fortress Dimon wanders into Detroit today to talk about the labor markets. What else do we have?
AMH joining us in about 10 minutes on part of that story. Just your earnings after the bell, a little bit later, after the market close. We'll get some earnings from FedEx. Look out for that a little bit later on. Joining us around the table here in London, the conversations continue. Patrick Armstrong, CIO of Plurimi Wealth. Patrick, good to see you.
Good to see you.
Are things good or just terrible? Because I can't decide based on our conversations so far.
Normal. Things are pretty normal.
No change.
Everything feels so different to how it was, but we've got inflation on a track down to something that's going to be sub 3% next year. I don't think it's going to fall to the Fed's mandate. I don't think they want it to. You've got economic growth that's a potential in the United States. Who would have thought that? You're probably going to go 2% for the U.S. economy this year. That's probably the long-term potential. Interest rates at 5% on the 2-year. It's pretty normal. Doesn't seem normal over recent years, but we're in an environment where things are pretty normal.
We're going back to the old normal.
I think we are going back to the old normal. I think inflation is going to prove to be persistent, sticky, with intermittent spikes, just because the big picture issues are populism and protectionism from governments, and that's just by its nature inflationary. You've got unions coming back like the 70s, maybe a little bit. You've got job seekers having some power. That's inflationary. But you've got disinflationary forces coming from China, and you've got Fed policy at a point where it is restrictive. So all of those things normal.
Your charm is your truly cross-asset. At the margin, how are you changing your cross-asset allocation into the fourth quarter?
So what we've done over the summer months is we've marginally reduced our equities that have just kept drifting to overweight. We wanted to have neutral weight, but just as equities have performed so well, they kept moving overweight. We've moved marginally underweight now. Not so much that we're worried about equities, that we're getting pretty compelling returns on tips right now, that you're getting a 2% real yield. And like I said, inflations are still a risk in the long term, but I'm getting the duration there. If we do fall into a recession, we'll see lower yields on conventionals, and tips will benefit from that.
So talk to our audience on radio and television here, and particularly across America. How does Patrick Armstrong utilize the 10-year inflation-adjusted yield or the 5-year inflation-adjusted yield? How do you use that as a tool to have confidence in market allocation?
Well, the 10-year break-even is 2.3%, and my view is we're going to have persistent above Fed target inflation, so I want to be hedged against that. I'm happy to get a real yield of 2%. You put your capital at risk to preserve capital as a starting point and grow the purchasing power of that over time. The tip provides that to you right now on the 10-year, so I like duration there. But you're being compensated with really high yields on, we talked about Diamond.
Yeah.
JP Morgan bonds, I'm getting 6% on a 2-year, and that's almost a
That's a Chris Whalen moment.
Yeah.
He's channeling Chris Whalen, those JP Morgan preferreds, Whalen would say.
Should we do single names? A lot of people at the start of the year were getting jacked up on LVMH. The portfolios.
I was one of them.
You were too. You backed away.
Yeah.
You stepped away. The poster chart of the European market now is Novo Nordisk. Where are you on that?
That's my biggest stock right now. And again, it's come from drifting. The pandemic used to be COVID. The pandemic's obesity and diabetes in the West. And Novo Nordisk and Eli Lilly, they don't have monopoly positions, but they got the dominant share here, growing earnings.
If luxury come in enough off China gloom, Bernstein, I believe, was out with a note overnight saying we've got some ratios of luxury back to 2008. Is it pulled back enough for Patrick Armstrong?
No, almost. So I sold LVMH in March. It was at 32 times forecast earnings. We're now in the mid-20s. I bought it in October the previous year when it was at 21 times. That's a small premium to the market multiple. That's where I'd like to buy it. So I think it's fair.
Folks, right there, we don't do much equity chat because, you know, who cares? The answer is what you just heard there from Patrick Armstrong is a clinic on how you bracket a beloved dominant stock.
I was with you. We were talking about it when you backed out of LVMH. You kept Immerse, though.
We did, yes.
Why was that?
Well, I didn't want to move against what I still think is the dominant trend is the spending power of high net worth individuals and also the immunity to input prices. Rishwan talked about inflation hurting spending power of people, but the input prices are things that are hurting mass market retailers, and it doesn't impact the high-end luxury.
So what's a distinctive feature of the Dumas family at Hermes? What are they doing differently? Bloomberg Intelligence, Deborah Aitken is just brilliant on this, and she singles out a few of these names. What is the Hermes model that makes them different from 47 other luxury brands?
The leather goods part of it is incredible. The margins, the growth they get there, and people pay up for that. And there's just waiting lines of queues for that side of things. But it's their brand management, the Hermes scarves and ties, and the leather goods. It's all, yeah.
We touched on it briefly. Let's finish there. Novo Nordisk. We're already up 40% this year. The stock's been climbing for 5 consecutive years. Can you spend just a little bit of time, a couple of minutes, just outlining how big this opportunity actually is?
Well, it was a vanity-type drug, their weight loss. It is a vanity product, basically, that people in Europe, America, and China, they spent the money to look good, feel good, but what they found is that the heart disease and the benefits on that, it may become an insurable product as well. So that just expands the potential market where you're not just getting vanity uses, but health uses, which may be insurable as well. So heart and stroke disease, it does expand the market a lot because it's an expensive product that a lot of people can afford. It may move much more mass market because of that.
The run on this stock, Tom, has been phenomenal, absolutely phenomenal. I'm not sure where we are right now versus LVMH, but certainly at one point earlier this year, it was bigger than LVMH, right?
I think it's bigger right now. They're basically the same market caps.
Can there be European exceptionalism without technology? The way we trumpet Apple and the other 18 states.
Well, Novo Nordisk, I think, is a form of U.S. exceptionalism.
Yeah,
the wrong kind of U.S. exceptionalism, right?
Yeah.
It's buoyant, to say the least.
It's, it's exceptionalism is very clear in U.S. in technology. Europe can compete in healthcare. It's shown no ability to
Quickly, are you buying big oil? You buying big oil here with $100 a barrel?
Basically, there's going to be more oil consumed in the next 3 months. We've already had more oil consumed today.
Single best buy. Come on, Patrick Armstrong, single best buy, big oil.
EOG, I like, rather than the integrated exploration production.
Patrick, good to see you. Patrick Armstrong of Plurimi Wealth. If you are just tuning in, welcome to the program on the S&P 500 right now. We are positive. We're positive by 0.2%. Outside of the equity market and the bond market, yields are a little bit lower by a couple of basis points at 434. Lots to talk about in fixed income. We'll do that with Alberto Gallo of Andromeda Capital Management. That's going to take place a little bit later on this morning. TK, some amazing calls there from Patrick. Novo Nordisk, the European healthcare company at the epicenter of the U.S. health epidemic right now.
Yeah, he's been so on. I mean, the thing about Patrick that's great is a cross-asset view that he takes all the time. And, you know, you mentioned this, I think, yesterday, the day before, John. Everybody's got to recalibrate where the Q4 outlook, September 30 ending Q3, is maybe as important as the year-end outlook this time around.
Well, I think this time around for the Federal Reserve, they're market to market. Growth has just been so much better than we thought it would be. We already know that. The Fed's just got to update their forecast to take account for that, Tom, into year-end.
You know where I am in the parlor game. I just, and thank you for bringing up the dots. Let's review this right now. We've heard this morning that the 23 dot has value. There's a 24 dot. Is there a Draghi 25 dot? Are they going to go out to?
So let's just sit on the dots. We've got a couple of seconds. So for 2023, the median dot is expected to still show one hike this year. Might come in, we'll see if it does. 2024 has some easing baked in, but it's what's behind the easing that I think is really important. Is it a collapsing growth that leads to these rate cut calls, or is it just this idea that inflation comes in, the Fed's focused on real rates and wants to maintain that restrictiveness? They're two very different things, Tom.
I think looking out that far, post-pandemic, as I mentioned to Dr. Kasman, can you look out that far given post-COVID supply and demand dynamics? I don't think you can.
Up next on this program, we'll look out to Detroit, the tension between UAW and the Big Three, and get the latest from the UN General Assembly. Bloomberg's Anne-Marie, next from New York.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Thursday, Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
When it comes to China, I want to be clear and consistent. We seek to responsibly manage the competition between our countries. We are for de-risking, not decoupling with China. We will push back on aggression and intimidation and defend the rules of the road.
It's an interesting word that President Biden used addressing the United Nations General Assembly just yesterday. He said we are de-risking, not decoupling. Curious because the Treasury Secretary went to China, Tom, and used the word diversifying. So which one is it? What's the message they want to send to China? Do you want to say de-risking? Because de-risking to me sounds pretty loaded. Are you saying China's the risk?
I think the political football here is substantial, and I'm going to say it's policy made up as you go. I think they're literally making it up as you go based on what China's doing and what the dialogue is. Very importantly, the meeting, Emery Horton talked about the meeting in Malta. Yep. Malta's an island in the Mediterranean. I don't know if you knew that. And
I'm well aware.
They had a meeting there of worthies to get Biden and Xi together. And that would be important. I mean, that's what diplomacy's about.
If we can make that happen, maybe a little bit later on this year. If you are just joining us, welcome. Federal Reserve decision a little bit later on this afternoon. No change to rates expected. Big focus on the forecast. Growth, inflation, the dot plot. That news conference won't be a snooze fest. A sleepy start to the week so far, though, in the equity market. Futures just a little bit positive here by about 0.2% on the S&P. Yields a little bit lower by 2 basis points on a 10-year. 434, Tom. 07.
It is a busy week in New York and the island of Manhattan. It is traffic status. Pharaoh had a tantrum and said, we're going to London during the UN so we can miss it all. Emery Horton doesn't have that advantage. She is in the heart of Manhattan with the United Nations meetings. A very important interview yesterday with the leadership of Poland, of course, so adjacent to what's going on in Ukraine. But this morning here in London, Anne-Marie, I think we've ignored, I've been wrong on this with the Fed Day and all, we've ignored Detroit and the UAW. Who does the president need to speak to today? When he gets up and dials 1-800-DETROIT, who does the president want to talk to on UAW strikes?
Well, the White House has been talking to everyone, right? They're going to be speaking to the UAW president, Sean Fain, but they're also talking to the executives of the big three auto workers. This has taken on more importance, this story, because Friday at 10 a.m., we will hear from Sean Fain. He's going to be holding a Facebook Live, and that's really this new date for the negotiations to look forward to try to strike a deal, or he's going to announce more walkouts at more plants. The administration is in a very difficult position at the moment. Not only is the former president going to be heading to Detroit the day of the Republican debate, so really stealing the show from everyone, but the administration said they would be sending Julie Su, the acting labor secretary, as well as Gene Sperling, a White House advisor, who's the individual who's the liaison between the White House as well as the UAW and the big three. And those two individuals have yet to show up to Detroit. And I was reading a political article yesterday, a Democratic strategist said Trump scooped us. And at this point, it's not even about sending, that now they look like, are they going to be following Trump's tail by sending someone, a high-profile person? But the bigger issue, I think, is the fact that they said they were going to be sending Julie Su and Gene Sperling, and that has yet to happen.
Maybe it's a silliness and symbolism of the Detroit leaders an age ago driving to Washington to do whatever they did. Maybe the president needs to get in his Corvette and head up to Detroit. With that said, there's percolation in news. There was a union settlement in Canada overnight. There's also the idea that there's a tangential knock-on effects of the strike where the automakers are shutting down other factories. Do those kind of tea leaves, do they have any impact on the debate?
I'm sure they do. I'm sure Sean Fain sees all of this. One, the extractions workers were able to get in Canada, but also the fact that this could be impacting the knock-on effect, the supply chain effect that this is going to have on these communities. So they're obviously going to be taking stock of all of this, but he wants to use this moment to extract as much leverage as he can from the big three auto companies, and the big three are saying they're still at the negotiating table.
Where's the leverage, John? 32-hour work week? Help me here.
Pay at the moment, it looks like they can get more out of them on that side.
That's it.
Stellantis has certainly come up. Anne-Marie, just to expand on the political conversation, you get the sense from UAW that they are sick of politicians playing politics with their cause. This is what you heard with the UAW president yesterday, and I'll share this quote with our audience, and I'd love your take on it, AMH. Every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. Is the former president still trying to go to Detroit on September 27?
The reports are that he is going to go there, and I think there's two key things we need to look at through the political lens. One is the fact that Trump won Michigan in 2016, a state that the Republicans have been unable to flip since the late 1980s. And a lot of this, if you look at, was potentially some of these rank and file members, not the UAW leadership. They would not endorse him. They're not going to endorse him in this round either. But then Trump lost it in 2020. This, I don't need to tell you, is a must-win state for Democrats. That's the first thing. I would also bring up the point that a lot of union leaders remember what Trump said in 2015 when he was campaigning. Remember when a number of automakers were talking about building facilities in Mexico, especially Ford, putting billions of dollars in Mexico. Trump said, why would you do that? Just move to a better U.S. state where you don't have labor, where you don't have union leadership. Get cheap labor, and then those people will realize they've lost their jobs, and then you can go back to your old factories. Right. And this deeply annoyed the UAW leadership, who said, philosophically, what is the difference of this? We are not being respected as a middle class, a working class. And those memories, I would say, they are still front and center for a lot of these individuals when it comes to the former president.
Emery, I got a segue here to your important conversation today. And as the gentleman from Poland was speaking in Polish, for me it was lost in translation, except boy, was there a tension in that conversation. Describe the tension that Poland faces at this moment.
Well, listen, Andrzej Duda has really been lifted by Putin's invasion of Ukraine to this global statesman almost. Remember in the start of the war, everyone was going into Ukraine, they still are, through Poland. He was this conduit between Kyiv and Western leaders, and he had this very close relationship with President Zelensky. He still does. But there is a ton of friction right now in this relationship that is playing out in the media. And what President Duda said to me is that his only plea right now would say, please stop doing this in the media, really taking a swipe there at President Volodymyr Zelensky. And some of the big friction comes down to the fact that we're not seeing a lot of Ukrainian grain moving out of the Black Sea corridor, so it's going into Europe. And Poland is saying, and they refused some of these tariffs at first to make sure they can help the Ukrainian farmers. But now what he's saying is that our farmers are not making the money they need to be making because there's too much cheap Ukrainian grain here. Zelensky wants to take this to the WTO, so they're having this spat about Ukrainian grain. At the same time, there's also debate within the Polish government about the financial aid from the Polish government to Ukrainian refugees who are settling in Poland. Just like you're seeing here in America, people are saying, we are dealing with high inflation, we are dealing with higher costs of living. You're hearing this kind of conversation around the globe, whether it's Germany, whether it's Poland, and that is why you're seeing a little bit of war fatigue.
Anne-Marie, this is a wartime president facing a unique situation that these other leaders do not face. I think we have to acknowledge that.
Yes.
He's been celebrated by the West for the way he's spoken about the needs of his own country. I was listening to Speaker McCarthy yesterday. Do you get the sense that a lot of people, perhaps in Washington, of a certain politics are becoming frustrated with Zelensky's approach in the media?
I think some of them think that the approach in the media is a bit combative. And we saw that on display yesterday with the Polish president. He said he wishes, stop playing this out in the media. We've been strong supporters of Ukraine. Speaker McCarthy said yesterday that he just has a lot of questions for President Zelensky about where the U.S. taxpayer dollars are going. And remember, the last time Zelensky was in Washington, he gave this joint address. This is just going to be a huddle between lawmakers.
AMH, thank you. The latest in New York, fantastic work at the UN General Assembly, fantastic collection of interviews over the last couple of days. The NATO Secretary General and the leader of Poland. Equities right now positive by 0.2%. Coming up shortly, the brilliant Deborah Cunningham of Federated Hermes. That's next. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Equities positive here by 0.2% on the S&P 500. On the Nasdaq, slightly elevated. Some outperformance on the Russell. The small caps doing better than a good, up by 0.4% on the Russell this morning. We calling that a surge, TK?
Surge.
Is that how sleepy
Laurie
things have been?
Calvasine has
The
been brilliant on
0.4% is a
You know,
surge.
I'm like, when does small cap calm down and actually put it on? And the answer is, there's so much angst out there, small cap really can't get it going.
Jill Carey-Hall of Bank of America has been good on this as well. I want to turn to the bond market briefly as well. 2-year, 10-year, 30-year. We've got a rally in the UK. 2-year yields in the UK down by more than 10 basis points. A soft inflation print. Hot inflation print in Canada yesterday, lighting a fuse under this bond market. Yields shooting higher. New cycle highs on a 10-year. We back away from it. We're down about a basis point on a 10-year to 434.47. But Tom, looking at that, you'd have to say we really have started to internalize high for longer. When you see
I
2-year
strongly agree with
north of 5%.
We are beginning to internalize the yield structures of another time and place, think 2005, 2006, and many of the different measurements we look like. You draw a horizontal line, John, and it takes you back to 08, 07, dare I say even to before August of 2007. What I end up looking at every morning, folks, is the 10-year real yield, and it's sort of in between 1.96 maybe is where we are right now in USGGT10.
Oh, that's the ticker on the Bloomberg. Nice.
But the answer is that's what I'm going to look at as we go through the press conference today to see what the real yield does.
If you look at USGG2YR, which is the nominal yield.
Good.
Thank you. Thank you. That's just north of 5%. 430s on a 10-year, 440s on a 30-year.
People just drove off the road on Bloomberg Radio.
I mentioned that rally in the gilt market for the UK bond curve. Yields down almost across the curve, particularly at the front end. This move in sterling weaker off the back of that. The pound against the US dollar, 123.65. We're negative by 0.2%. Tom, just looking at the inflation data out of the UK. So the good news is that it's no longer the 7% we expected. The bad news is this number still comes in at 6.7% year over year. And core, Tom, is down from 6.4, great, but it's still 6.3. So there's still an inflation problem in the UK, and we're still talking up wage growth that's pushing 8% in the United Kingdom. So the pressure's still on this Bank of England. Goldman's dropped its call for rate hikes for tomorrow, and they think over at Goldman, based off what we're hearing from the London desk this morning, is that the Bank of England is done. This is the peak rate. They're going to stay there. Question I've got, Tom, if you're going to stay there, how long for? With CPI where it is, with wage growth where it is, how long have they got to stay at these levels for?
It's essentially it's a boom economy that everybody's been wrong on. There's been a lot of gloom out there, and it's its own idiosyncratic story here. And part of it, to me, dovetails off Brexit and the relationship with Europe. And, frankly, I think the United Kingdom needs a strong Europe, and it's not there right now.
It isn't at all, based on what we heard from President Lagarde of the ECB last week. Nothing strong about that news conference.
I read Phil Serafino's stuff
last week. Phil's great. 107.01 on the euro at the moment. That currency pair positive by 0.2%. Under surveillance this morning, the Fed rate decision due out 2 p.m. this afternoon. A pause is widely expected But a bit more debate around what this Bank of England will do tomorrow after UK inflation unexpectedly fell. Goldman altering their call, writing this: with today's data, 2 out of the 3 indicators that the Monetary Policy Committee has set out to monitor inflation persistence have now shown notably more progress than anticipated since the August meeting. We now expect the MPC to keep rates unchanged. Once you've got through the Bank of England, Tom, it's on to the BOJ on Friday.
Catherine Mann's going to push against that. She is American, Brandeis University, of course, her wonderful work at Citigroup. She is on the MPC, the Bank of England, and I would suggest that Dr. Mann would say, let's watch the data. And to your point on change in vector versus level, to everyone in the United Kingdom, it's that level above 6% that's intolerable.
I'm with you. That split on the MPC, let's see what that split looks like.
Yeah, they never dissent. I mean, you know, they dissent.
We get a dissent on Fred Mead, but we don't get any dissent over at the
Fed is, you know,
Federal Reserve.
It's a snooze fest.
Singing off the same hymn sheet, apparently. Oil dipping this morning after a soaring summer rally. Saw prices rise more than 20% over the past 3 months. Crude touching 10-month highs, approaching $100 a barrel in the last 24 hours on the back of supply cuts from OPEC+, but falling back below 94 ahead of this afternoon's Fed meeting. 93.75 after a sniff, Tom, of 95.
Yeah, I think, you know, a bit of the story's missed here. This has to do, again, with oil in the Caspian Sea. This has to do with Azerbaijan. I'm not going to pretend I'm an expert on it, but it is the ageless battle of those Caspian states, Georgia, Nagorno-Karabakh, and the rest. Amory Horton's way better. Maria Tadeo's expert on this. But there was a little bit of war tone yesterday, which got us up to Saudi 97. It got us up to 95 on Brent crude. And there seems to be not peace in the air, but maybe the tensions pulled back off the Caspian Sea today.
Fantastic to catch up with Javier Blas of Bloomberg a little bit earlier today, who basically said it's all about price for Saudis now. And they've got a higher tolerance for economic stress abroad. They want prices near 100. His opinion, maybe that resonates, but that's his view.
He walks in the building and the foundation shakes. I mean, you know, he's huge.
He's a heavyweight.
He's a heavyweight.
A heavyweight in the world of commodities. I want to finish on this, an update on UAW. United Auto Workers weighing in on expanding their strikes as negotiations with Detroit's automakers continue. The union is set to hold a Facebook Live event at 10 a.m. Friday, where it's expected they will discuss whether more plants will join the strike. So like we had last week, we have a deadline. It's noon Eastern on Friday, TK, for further progress. If we don't have that sign of progress, ultimately 2 hours before that, we're going to get some kind of Facebook Live event, some kind of news conference from UAW, which may signal a broadening, deepening of these strikes.
Walter Reuther would have done it this way. I mean, it's not your father or your grandfather's strike of union members. Are these companies the same companies and acting in the same process as they did in 1958 or the tensions of the 70s? I don't think we know yet.
So you can answer that question. I'll answer this one. UAW certainly changed their approach based on the assessment I've seen.
Absolutely.
This isn't targeting one. This is targeting all three simultaneously at the same time.
And they know, they're sophisticated enough to know the knock-on effect. One of the makers came out and said, you know, if you're going to take out my Bronco factory or you're going to take out Michigan Truck, well, then you got to go out, and there's this knock-on effect of 14 other factories, and literally in the next 48 hours.
And tons of other companies down the supply chain.
Yeah.
Tom, who are going to be hit by this as well. It's not just Detroit's big three, that's for sure. It's
Continue to
a load
follow
of
that
companies.
Great team in Detroit leading that coverage, and we'll catch up with them through the day, this Fed day, I should say. Right now, this is an important conversation, and please lean forward as you figure out what to do with your short-term money. Deborah Cunningham, a fancy title, Global Liquidity Market CIO. It federated, essentially they invented the money market fund, and with Federated Hermes, she joins us this morning. Deborah, what do you see in money market fund flows? What are we doing as we migrate from banks to a higher yield money market funds?
Well, certainly we've seen it in, full force over the course of the last 6 months. And it's really, it began back in March of 2022 when the Fed increased rates for the first time. You've basically got in its, sort of most inclusive form, money market funds with assets greater than $6 trillion now. So, if you kind of go back to the, days post-Lehman, this is 3 to 4 times what the market was at that point, and certainly what it was in the zero interest rate environment. So at 5+%, money market funds, especially for the retail investor, offer great returns at this point.
Deborah, I look at the Keefe, Bruyette, and Woods Bank Index, the so-called BKX, and it's sobering, to say the least. What is a federated belief? And I know you're doing rates, it's maybe outside your remit, but how do you look through the Cunningham prism at what our beleaguered regional banks are doing?
You know, Tom, we do a lot of business with the banking sector from an investment perspective as well as from a counterpart standpoint. So we're always looking at the health of banks and, you know, what their activity in the market might be looking like. And at this point, the largest and what I'll call regional and kind of super regional banks seem to be quite healthy. Even, you know, in the context of the commercial real estate portfolio, there seems to be, a pretty good mix of what I would call the better types of commercial real estate within those larger banks. Now, some of the much more, much smaller, very concentrated regionally and geographically smaller banks, that profile is not the same. So I think what you might end up seeing through this next cycle from a banking perspective is a little bit more consolidation of some of those smaller banks into some of those larger, sort of regionals and super regionals in order to keep the market in overall, in an overall healthy sense through, what might be the next downturn from an economic standpoint.
Deborah, we'd love your view on the Federal Reserve a little bit later this afternoon. Andrew Honhorst, the City, just published moments ago. He had this to say: the Fed will skip hiking rates at 2 p.m., but dots will likely signal one further 25 basis point hike in 23. The median dot for 2024, they think over at Citi is at risk of rising 25 basis points. It's all incremental stuff, Deborah. For you and the team, when you get those projections a little bit later, what are you and the team looking for?
I think definitely a skip, not a pause. And I do think, they're going to emphasize that November continues to be a live meeting. I would not be surprised to see the economic projections and the medium dot to go up by 25 basis points more. Ultimately, although inflation, is lower than it was 3 months ago when these numbers came out, it's still firm. And in the most recent information, CPI, PPI, PCE, retail sales, they're showing the consumer being very strong and some of those numbers playing through to mild increases in those numbers. So we would not be surprised. I agree with you that, the market maybe is finally reconciling with higher for longer, but I'm not sure we've priced in what we think is a real live meeting in November at this point.
Hollenhorst cites three things, Deborah: oil prices, ongoing UAW strike, third thing, renewed advance in house prices. How do you think the chairman navigates those three issues?
I think all of them have to be addressed. I mean, they impact the consumer. And granted, the consumer has, from a wage inflation standpoint, also been improving from, a household net worth standpoint. But they are paying higher energy costs, they're paying higher food costs, they're paying higher shelter costs, and all of that comes out of their discretionary spending. So I think as the engine of growth to keep this economy, sort of above water, there's a little bit of a pullback on that from the consumer standpoint at this time. So, the chairman can't ignore that, but by the same token, are they going to be able to, marginalize and not raise interest rates by another 25 basis points? I think it's going to be a tough decision, but one that will, make the November meeting a little bit more, sort of in the limelight and focus for interest rates in the next several months.
Your view, you're not alone. Mike Gapen, Bank of America, Andrew Honhorst, the City, on the same page. Deborah, thank you. Deborah Cunningham there, Federated Hermes, the Federated Hermes view on the Federal Reserve. If you are just tuning in, welcome to the program. The S&P 500 right now is just about positive by 0.25%. Outside of that, into the bond market, yields are a little bit lower by a single basis point at 434.47. I mentioned that research from Andrew Honhorst, the chief US economist over at Citi, who had this to say: Chair Powell acknowledged recently softer inflation and lower job openings, but emphasize vigilance, he says, given remaining upside risk to inflation on those three issues that I mentioned, including the rise in oil prices, ongoing UAW strike, third one, renewed advance in house prices. Tom, of those three, what are you focused on? Strike, commodities, house prices?
I'm not focused on the political story. I don't think the Fed really does a mandate off of that. Maybe Greenspan would have a million years ago. I don't see it with Powell. I do see it with the house prices. I think they'll watch it very carefully. And to Paul Krugman's idea of plain vanilla inflation and rents are shocking. Yeah, I guess they're down in the West. But the answer to me is you got to get from the soup, the alphabet soup of inflation indicators Deborah Cunningham just brought up, to what our viewers and listeners are feeling. Powell viscerally knows that, and he can't go accommodative until he's got more of a vector in place. It's not in place yet.
So acknowledge progress without signaling victory.
Yeah, exactly.
Ultimately,
he's not going to declare victory as Governor Bailey.
I don't think Governor Bailey can declare victory.
No, but he alluded to it a couple of meetings ago, and none of these people are anywhere near this. It goes back to what Wells Fargo said about the last mile. We're not in the last mile. We're like on the last time zone. We're
Sarah
not there
House.
yet.
Sarah House was right. That last mile is going to be tough. Coming up next, the treat here in London. Kathy Wood of Ark Invest. That conversation coming up shortly. Live from the city. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US a bit higher, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
Based on what we heard from Max Kantner, the chief multi-asset strategist over at HSBC, it feels like Goldilocks forever for Max. At least Goldilocks for now. Constructive on risk assets. If you're just tuning in, welcome. Equity's doing okay. Positive this morning by 0.2% on the S&P 500. Going into this Fed decision, cycle highs on a 10-year yield in the last 24 hours. Backing away from that just a little bit, down a basis point on a 10-year, Tom. 434.67 on a 2-year, still dancing in and around 5%.
I'm going to look at the real yield. The oil pullback, oil's been front and center this week, but into these 3 meetings, I've got to look at inflation-adjusted yields. Patrick Armstrong, I think, was very articulate about that. That's where he is. That's where he's finding protection. But to see what the real yield does off the chit-chat today, and I agree with what we've heard on to November and, frankly, a focus to December as well with the Fed.
The risk of one more hike. Andrew Hollenhorst, Citi, Matt Gaper, BofA, Deborah Cunningham there. Same thing.
Yeah, there's a lot of cross currents here. We'll have this for you this afternoon. Remind me what we're doing, John. We're at 1:30. We're starting
Eastern time, so 6:30 London time. We'll start the Fed special.
We'll
get the decision
hour.
30 minutes later.
This. That's good.
And then we'll beat the drum into the news conference 30 minutes
after that. Into the news conference as well. And we'll be with you tomorrow, of course, for Bank of England. And who's on Friday?
BOJ.
BOJ. And that'll be interesting for Mr. Ueda. as well. We welcome all of you worldwide on Bloomberg Radio and Bloomberg Television to a conversation of great anticipation. Cathie Wood came out of USC a long time ago, put out a shingle with a Lovelace family at Capital Group, and then built an investment career quite different from others, not so much based on the long-term solidity of a given portfolio, but capturing the trend, going up large, and it's sometimes going down large. She holds court on the Ark. Noah's Ark is where she is right now. I want to know, with all you've been through the last number of years, are you going to shift to a more long-term strategy? I look at Morningstar, 1 year, 3 year, 5 year, your bottom quartile, but your claim is more short-term. With your new ETF effort and with what you're doing with Ark, are you going to be still on trend, or do you invest more for long-term?
We've always invested for the long term. And what interrupted what was a very nice move up in innovation stocks, especially disruptive innovation, was a massive increase in interest rates, the likes of which we have never seen.
Of course.
24-fold increase. So all long duration assets, especially in 2022, were destroyed, including bonds, which are usually a flight to safety. They had their worst year last year since the 1700s. There's no way in that environment that our strategy would have done well. But I do think that what's happening this year is that the market is starting to look over the Fed's moves, whether there's one more or not, into falling interest rates. You know, we started underperforming in 21 just with the anticipation of rising rates, and even more so in 22.
So how are you going to change? I want to know how you're going to change the sobering quarters you've been through. What is the new Cathie Wood approach to macroeconomics, frankly, pandemic economics, intruding on your belief in innovation?
If anything, innovation gains traction during tough times. And if you look at how the reason our portfolios are outperforming this year is... And they are. It is because they are gaining share in what is becoming a difficult environment. Right? And so one by one, we're going to earn our way back, and it's all about revenue growth, margin expansion.
Okay. In the Wall Street Journal, they do a fabulous thing with old farts like me, and it's people with over $5 million, and they believed in Cathie Wood. To a person, those retirees bought innovation, they bought tech, they bought Apple, and they didn't listen to financial TV or radio. Can you do the Cathie Wood approach for 1, 3, 5 years, given the volatility you've seen?
Yes, I think we're on the other side of that massive interest rate increase, which did destroy a lot of performance. That's the most important thing. And we are ready for prime time. Many people are concerned about our kind of strategy, and the company we just acquired, Rises, because in Europe, in London here, for all of Europe and UK, they're focused on global megatrends as well. And, you know, interest rates hurt everyone in that space. If we are right, and rates are going to come down at some point in the next year, you know, the market is a discounting mechanism, then I think that the muscle memory that hurt our strategy, and it all has everything to do with the tech and telecom bust, and people thinking, oh my gosh, are we here again? No. What happened during the 20 years that ended in the tech and telecom bubble is the seeds for what is happening now were planted.
Yeah. And this, John, is really important, and that the profitability stream down the income statement of new tech is very different than 2000 tech.
Let's talk about EVs.
Yes.
And not just Tesla.
Yes.
Is it good news for Tesla what's happening in Detroit right now?
Yes, because if there's a strike, of course, there will be more production shortfalls. You know, I think that there's just now the supply chain has freed up, so unfortunately we'll have all kinds of questions about that. But you know, I don't think it has anything really to do with the strike. It has everything to do with the consumer preference shift towards better vehicles, electric, that are falling in price. Tesla is leading that price decline simply by passing cost declines on to its customers. So I think that's what's good for Tesla.
The complaint we hear is that people can't afford these vehicles. What we're seeing in the news
changing.
in the UK, as you can see, Rishi Sunak is pushing back targets to get rid of all of these internal combustion engines to 2035 from 2030. Are we being unrealistic about this transition and how difficult this is going to be?
No, we do not think so. We actually, the total cost of ownership, now this is in the United States, it's a little bit different here, but the total cost of ownership of an electric vehicle fell below that of a gas-powered vehicle about 2 to 3 years ago. Soon, sticker prices.
Does that include insurance?
Yes, includes insurance. Yes, as I said, local differences, but yes, in the United States, that does include insurance. And in fact, Tesla is so sure that its cars will have fewer accidents and fewer fatalities that it's willing to provide insurance. So yes, that does include everything, all in.
You were at USC, you didn't get a B. Laffer called up Robert Kirby at Capital Group and said, just shut up and hire her. So you walk into Capital Group, which is the land of an R-squared and 98 Washington Mutual Fund, Investment Company of America. Yes. Everything is completely diversified out. You're the polar extreme. They threw you out. You almost fell into the Pacific Ocean. They were so upset with you. So you go out and you say, I'm not going tight R-squared to SPX. I'm going out and do my own thing.
Yes.
People have prospered off of innovation and technology. How does that continue in America? Can you be less diversified and win 5 years out?
Well, you mentioned Capital Group, and that is where I did start my career. And that is where I saw tremendous research and a long-term time horizon. So really what we're doing with ARC is just going back to the future. My initial experience, which was in the late 70s when I was in college, and we're doing deep research, first principles based, white sheet of paper.
But you're away from an R-squared like Washington Mutual or the other funds. What's your R-squared right now?
To be honest, the correlation of our performance to broad-based benchmarks is very low. For better or worse, what it tells our clients and prospective clients is we have a very good diversification strategy. Our funds, the active weight, if you're comparing to MSCI World or S&P or NASDAQ, the active weight is less than 5%. So really good diversification strategy focused on companies that are going to transform the way the world works. We look at the broad-based benchmarks, and sure, there are companies that are sustaining innovation like an Apple, but they are not going to transform the way the world works from here. Our companies are.
Kathy, thank you. Kathy Wood of ARK Invest. I can't believe it's been 3 years. It was right before the pandemic and New York shut down.
Yeah, well, she ignores us. We've tried to get her
out. That long. You've been ignoring us, Kathy.
No.
That's what this is about. Come on.
We should mention she's got a new ETF in Europe. They're bringing it into the ARC model as well.
And we should talk about
the
growth
Europeanizing. Probably Novo, what's it called? Novo
growth stocks in
obesity?
Europe?
Yeah,
Novo Obesity, is that what it's called now?
Yeah.
Over at Novo Nordisk.
Yeah.
Alberto Gallo, coming up next. Futures positive here on the S&P. This is Bloomberg.
Off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come. don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
If you get yields moving higher, that's probably in response to growth doing better.
I worry more about a yield-induced issue somewhere.
I think a lot of our economic models just aren't working now. The pandemic's just thrown them into disarray.
I did raise my outlook for a recession risk from 15% to 25%.
We can't have Goldilocks forever. We are going to start to see biting within the growth standpoint.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, across America, worldwide, from our studios in London. Lisa on assignment here. It's going to be an interesting hour. We start strong here for Global Wall Street. We'll go to bonds here in a moment with Alberto Gallo. But, John, we've got to focus on this Fed meeting coming up, cocktail hour in London. It's a different Fed meeting.
It's a different Fed meeting for us. It's a different Fed meeting for others as well. We do get forecast today. Unchanged is the call, but it's the forecast we want to have the discussion about with Kathy Jones at Charles Schwab, Matt Lazzetti at Deutsche Bank, Diane Swank at KPMG, and Andrew Holdenhorst at Citi. How do these forecasts change? They're going to have to market growth. Growth has been better. Growth is going to be evaluated higher, we expect, Tom. Inflation may be a little bit lower. That's 23. What about the dot plot for 3 and 24? That's going to be the call here. Where do they see interest rates going into year end? Maybe one more hike. Let's see if they back away from that. Where do they see interest rates going into next year?
That's the Mike McKee guy idea, the parlor game of it, as you will. What I like there is we're going to get from Diane Swank the effect of the UAW strike is one of the worries that are out there. Andrew Hollenhorst lines them up like ducks this morning. His Citibank worries where you stay up at a higher rate. Matt Lazzetti modeling out a slower economic growth. And there's different narratives here that Chairman Powell has to calm. I look for a calming voice
It's
today.
a timely news conference, Tom. Those three issues that Citi talked about, crude in the 90s, UAW strike ongoing, house prices recovering. Do they have the inflation data behind them, the incoming information to say we've made progress? Absolutely. Can they declare victory in a meeting like today? No, they cannot. Which is going to be the story, likely, in the news conference.
In the heart of it, and one of our great themes here, particularly going to Bank of England tomorrow, is this phrase, anchored. Are central banks anchored? Do they have control of the moment now or the moment out 3 years, 5 years? And in England, it's a different challenge. The level of inflation, folks, over here is totally different than in the United States.
Has it improved? Is it lower in the UK? Yes. Is 6 a problem? Absolutely. It's a problem for the Bank of England. I'll give you two names, Tom. Elsa Linyos of RBC. She sat just over there.
Yeah.
Simon French of Panmure Gordon in Elsa's seat a day earlier. Both said the same thing. They think the communication of the Bank of England hasn't been good enough. It's been insufficient, and they face a credibility problem. Now the call from Goldman is no hike at all from the Bank of England tomorrow morning.
I was surprised
Goldman
by that.
thinks
Full
they're
disclosure.
done after that inflation report this morning. So big rally in the UK gilt market and sterling a bit weaker off the back of that data earlier on.
And let's get to the data, but I really want to say that the communication will be improved at the Bank of England if John Farrow could be in the press conference here that they have to talk to Governor Bailey. They just don't do them every time, do they?
Not every time.
That's the first mistake.
No, you get them when you get the forecast.
In the modern world.
You'd like a regular meeting and news conference from Governor Bailey?
Not really. You know me on communication as well. Let me communicate to you the data check. Oil pulls back a little bit. Yes, Azerbaijan and all near the Caspian Sea calms down, and it surged to 95. John, back a couple dollars, but 90 is a difficult number for Jerome Powell.
Equity session highs. We're looking pretty decent here, up 0.24%.
Dow Jones Industrial Average
on the S&P. I say we're looking pretty decent. I'm leaning on the call there of Savita Subramaniam, who's saying 4,600 on the S&P. That's an upgrade from 43. It's amazing to see these upgrades, Tom, just keep coming through when people are talking about the potential for weakness.
It's that time of year, but I want to make a point that when you have BNP Paribas upgrade in a jump condition to a new level from being very cautious, that's a different upgrade than the marginal upgrade we got from Savita.
True. Savita's still looking for upside, and Greg Bowdle at BNP is not.
Yeah. You know, I think that they can be different and nuanced. We're going to be different and nuanced here as we look at equities, bonds, currencies, commodities, at the dynamics of full faith and credit and the credit market. Expert on this across all geographies, but particularly Europe, is Alberto Gallo. He's with Andromeda Capital Management and joins us today on the tea leaves, John, to see from credit in your Europe.
The CIO and co-founder. Alberto, good to see you.
Thank you.
Why have I not heard the word stagflation more than 2-3 times this week? I thought I'd hear it every 10 minutes.
Well, you're in London and the UK is in stagflation, right? That's the wage dynamics. There's an entrenchment in inflation where you see, 8, 10, even 14% wage rises on an ongoing basis. And many of these negotiations embed a forward-looking raise, a forward-looking increase. So they're not just increasing one-off, but they're going to keep increasing. So the dynamics have changed. As a central bank, you should only say that inflation is transitory, if inflation has gone back to target. But calling it transitory ahead of time is obviously a credibility issue. And that's what the Bank of England is dealing with today. Unfortunately, they can't raise rates too much because of the over-levered situation in the property market and the household sector. So it's a lose-lose situation. The growth inflation mix is much worse. And against this, we have a consensus in the market, which is very relaxed, with very low volatility, very high equity valuations. Why? At the beginning of the year, everyone was very, very bearish, very positioned for a recession. But today, most investors, according to market surveys, are positioned for soft landing. So we've gone from one side of the boat to the other, and we have to deal with with a worse growth inflation mix going forward, both in the UK and the Eurozone.
And Europe, but not the US.
The US went to the party, and Europe got the hangover. So the differential in growth between the US and Europe is widening even more. We're seeing it in FX. But the US is not a recession risk. The US here is at reflation risk. Oil is a positive for the US. And inflation is going to be around 3%, but the economy can live with 5%. In fact, there's too many cuts priced in for the US next year.
Alberto, how do I invest in that world? Stagflation reality that you just outlined, and inflation reacceleration risk on the other side of the Atlantic. What am I meant to do?
So look, for sure, what you don't want to do is have a long only, buy everything. What worked with QE, that kind of strategy is not going to work going forward because there's going to be more volatility, there's going to be more relative value. So you have to be more tactical. Now, today, in an economy which has high inflation and a Fed that's priced for cuts, but it's not going to cut, which is what we think about the US, you don't really want to hold bonds. So we still see a potential for higher yields in the US, in the middle of the curve, in the long end. The BOJ is the elephant in the room for the world, of course. If they exit from zero rates, that creates pressures. In Europe, though, people worry about European recession, European high inflation. Europe, in the end, always grows between -1% and +1%. And, we are seeing a very muted situation. The 4% hike by the ECB is probably going to look like a policy mistake. So, and here, there's a premium. So we like being in Europe in bonds very selectively. And in the US, we think bond yields will keep going higher and spreads as well because there's too many cuts priced for next year.
I would suggest that's an outlier view. And if I look at the Bloomberg Total Return Index, the US aggregate index, very few people are really looking at price down. Are you suggesting that price down, yield up can breach the lows of price that we saw, I'm going to say 18 months ago?
We can go wider. I mean, we talked about it. I think long bonds, long duration was probably the most popular view in Q1. A lot of pitching.
Yeah.
And long U.S. investment grade up in quality has been super popular. But in the end, you're not.
But I don't mean to interrupt, but this is absolutely crucial, Alberto, as you take a real minority view here. If I get price down, yield up, no one's looking for that. What will be the market ramifications of a new regime within higher yields across credit and full faith in credit?
What everyone is hoping for is yields will go back down and companies will be able to refinance. But if yields stay, if interest rates stay at 5...
What's the stock market do?
The stock market is a little different from the economy, you see, because large companies have termed out their maturities. But if you're looking at the high yield market, which is smaller caps, then you need to see wider spreads. You need to see a rise in default rates. But yeah, of course, the stock market is complacent.
You've told us a lot about what you don't like. What do you like? I'm assuming you're not just sitting there in cash.
No, we like some areas of European markets and some U.S. areas of U.S. markets too. So we like Ukraine. We think that there is an improvement there. Slow but steady. They're doing the right thing, the right strategy. They're not throwing all the weapons and the resources at once. They're advancing slowly. And it's an opportunity that's been unloved by the market because of the binary risk of the war. We like some countries that are going back into the investable universe, like Greece, which has an investment grade upgrade ahead. And we like some defensive sectors, which in Europe are pretty, well capitalized compared to the US.
I thought I'd misheard you, but I'd like you to repeat it. You like Ukraine.
We like Ukraine.
What does investing in Ukraine look like?
Well, it looks like buying bonds that are essentially left for a very low recovery value. They were at 20 cents on the dollar at the beginning of the year, now at 30 cents on the dollar. And GDP in Ukraine is not far off from where it was pre-war because of all the support that foreign countries are giving to Ukraine. So,
how do you buy a bill, note, or bond in Ukraine? Do you have to be somebody fancy like you?
No.
Or can one of our listeners and viewers
it
purchase Ukraine this morning?
It is a distressed trade, but it's a dollar security, so it's a New York law security. So, like many other emerging market countries, which are restructuring, but the difference is that investors have not.
I got to ask a Bramo question. She's on assignment this morning. Help me here on high yield spreads. How many basis points do they widen out? Looking at a vanilla index of high yield spreads. I'm speaking as a hack.
Yeah, we're around 400 bips now in high yield. That's where we were in January, February. Yeah. But the differences are yields on the Treasury are pushing much wider, and spreads have not moved. There is a point where if rates and yields, long-term yields go wider, at some point something can break in the high yield market as companies need to refinance. And so we're looking for a little bit wider. We're looking for 450 or 500 to go back to a mean.
100 bips. Did I do okay there?
That was
I was trying to channel Bramo.
That Bramo would be proud. Thank you. Alberto, this was great. I always butcher your name. Not the name of yours, but the name of the firm. Andromeda Capital. I've got this.
Right.
Andromeda Capital Management.
They're in the aluminium business.
Alberto Gallo. You starting? They're in the aluminium business.
Aluminium business.
I like that. There you go. There you go.
I was at the Dorchester with a cocktail. I was at a miners thing last night at the Dorchester with an umbrella in the drink.
The LME.
And they were talking about aluminium.
Guys.
Yeah, aluminium.
If you're just tuning in, welcome to the program. TK adopting some English words for metals.
Yes, thank you.
Equity futures on the S&P 500 just about positive by 0.2%. Yields higher, then lower. We're down a basis point this morning, 434.47 on a US 10-year. Alberto, we hardly talked about Chairman Powell later on this afternoon. What's the guide here? Go to the pub, get some drinks, or actually watch this news conference this evening?
I think that his challenge will be to push back the expectations of cuts that are built into 2024 Fed futures. We've got over 100 bips of cuts. We've got oil towards $100. It's not a bad thing for the U.S. We're seeing, according to our models, around 3% headline inflation at the end of 24 in the U.S. So that's above target, but it could be 30, 40 bips higher if oil goes up another $10 from where we're now. So there's a risk that 3% goes to 3.5%.
So pub. this evening, right? That's what it sounded like. Alberto, thank you. Jonathan Pingle of UBS is coming up a little bit later. TK is going to be in the pub straight after that news conference begins. We'll run you through and keep beating the drum to that Federal Reserve decision later on this afternoon. 2 p.m. Eastern Time, expecting no change, but plenty of action when Mike McKee has to open up the summary of economic projections and get the outlook for growth, for inflation, and for interest rates as well. That so-called dot plot for 23, 24, and perhaps a little beyond too. Coming up shortly, Henrietta Trace of Vader Partners on the looming government shutdown. The shutdown that we just don't really want to talk about, but we've got to talk about because it's real. We're doing that again.
It's real.
I mean,
yeah, it's real.
Really? Okay, we're doing that next. From London, this is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Will the Fed hold rates steady as expected?
The Fed trying to back into the shrubs and disappear.
They're as data dependent as we've ever seen.
And will they keep one more hike in the dot plot?
The services prices are going to be a concern.
There is this risk. Maybe inflation starts to pick up again.
Trust Bloomberg for the fastest coverage and exclusive analysis.
You could see more headwinds.
They may actually tip the economy into recession before they start cutting rates.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Context changes everything.
I don't think anybody wins a shutdown. Think for one moment what a shutdown does. Stops paying our troops. How do you have more leverage in that situation? I've watched shutdown after shutdown. Everybody loses. It's not a continuing resolution. In the essence of what you've known Washington to be continuing resolution, this actually cuts wasteful spending. This secures the border. In the past, the continuing resolution was just continuing spending the money.
House Speaker Kevin McCarthy addressing criticisms of a short-term plan to prevent a U.S. government shutdown. It's that conversation all over again. Let's turn to the bond market briefly. 10-year this morning, going into that Fed decision a little bit later this afternoon. 434, yields down a couple of basis points. 2-year, 10-year cycle high in the last 24 hours. The 2-year on a closing basis point yesterday, on a closing basis, 5.09% in yesterday's session, Tom. The 2-year backing away from those levels to about 5.07. But on a closing basis, we're talking about cycle highs at the front end.
Yeah.
And on the 10-year, it's pretty remarkable stuff going into this Fed decision.
I thought it was underplayed yesterday, John. I think you're absolutely on here. We've really seen some movement here in yields. And yeah, we give it away here, West Texas Intermediate 90.44. I really want to emphasize, folks, still we're in London. Our team is fully focused on the Fed, and we'll be giving you our usual coverage this afternoon. Thrilled to do that from London here. Look for that. Matt Lozzetti, among others, Diane Swank joining us. as well. You know, I think, John, and I really want to explain it through a London prism here. What we're seeing is malleable politicians. And in London, we are seeing the Prime Minister of the United Kingdom flat out capitulate in the last 24 hours on the green movement in the United Kingdom, John. It's on the top of every newspaper here.
Some people might say it's being realistic to push back some of these targets
to get reelected.
2030 to 2035. Perhaps that's part of the equation. I imagine it is, to basically convey some differences between him and the other party sitting across from him. But realistic in the sense that this transition is going to be much, much harder than we make it out to be. The shifting away towards electric vehicles is not going to be that simple, and for many people will be increasingly expensive. Kathy Wood of Ark Invest sat around the table with us in the last 30 minutes and suggested prices can come down a whole lot more, led by the likes of Tesla. But let's have a look at what's happening with UAW right now and Detroit's Big Three. Do they look like companies that are going to be in a position to drive costs down, given where labor costs might be over the next 4 years and beyond?
And the business realities away from the wage discussion at the UAW. To bring it to America, once again, no, we're not looking at ESG in America. We're looking at government shutdown. We've ignored the story. We're going to dive into it right now with truly an expert, Henrietta Trey's Economics Policy Research Director, at Veda Partners. Henrietta, Washington Post, House flounders. How floundering is our political system right now in America?
They're on the ocean floor, just chilling with the flounders, for sure. It's been a train wreck for 9 months now, and it just will continue to be that way. The one thing I would say to investors watching this is be mindful of the calendar. It's Wednesday. We have 10 days before the government actually shuts down, and it's worth getting specific. That happens on a Saturday. No federal employees actually stop going to work until Monday. So we really have like 12 days to resolve this. That's a lifetime in D.C. I hate to nitpick, but it really is the most effective way to watch Washington, D.C. right.
Henrietta, I had a period where I realized I didn't know much about American politics of the 1890s, and this really harkens back to the vast polarization pre-Teddy Roosevelt, the time of Grover Cleveland Alexander and the rest. And what I want to know, Henrietta, is with the election coming up, do we get clarity here, or do you suggest more floundering past November of 2024?
I think we're going to flounder until 2024 November because we're going to be dealing with the exact same margins in the House and Senate for the rest of the period before the next election, all the way through January 3rd, 2025. And that is something to really bake in here. So if you don't believe that there's a shutdown happening in September, which is my base case scenario, you really are going to have to adapt to the fact that we're going to be in the same exact boat in December, probably again in April when the sequester cuts might actually go into effect, and then through the summer of next year as we head into the elections. And I think that there are about 5 House Republicans who would happily shut down the government for that entire period of time if they thought it would get them more campaign fundraising and attention.
Henrietta, I got an audience question just seconds ago. I'd like to share it with you, and perhaps you can help us answer it. We say things like government shutdown. They want to know how much of the government actually shuts down.
Great question. It's about 850,000 federal employees. The average salary is about $73,000. The Bureau of Economic Analysis, the Department of Labor will not be able to publish their data. That is hugely disruptive for people watching that on the street, for projects that are not funded independently. So just to be crystal here, the Federal Reserve is funded independently, so they won't have to worry about any of this. But any federal agency that operates via the discretion of Congress, which the majority of them, will see their expire.
Henrietta, Anchor emails in and says, do they shut down customs? Can John and I get back into the country?
You will be able to get back into the country if the FAA employees decide to work without pay. Last time around in 2018, LaGuardia shut down and had a stop flight order because you're asking these FAA folks who are, waving those pistons to say, hey, come in and work for free, because they're not getting paid. They are essential workers, but they will not be getting paid. The risk is real.
Does Speaker McCarthy, is he working for free? What's his shelf life right now? Give us the Trey's analysis of how the Speaker battles through this.
I'm going to keep it real with you. I do not think the House Freedom Caucus has the votes to oust Speaker McCarthy. I spent all day yesterday speaking with former and current Democratic staff. The motion to vacate a chair is the exact opposite of the hurdle for Speaker McCarthy that we saw in January. The burden is on the Freedom Caucus to get McCarthy ejected. They need 218 votes to do that. They probably get a majority, maybe like 45 House Freedom Caucus members, which is their whole caucus. But that leaves 177 other House Republicans who, by the way, just voted to install this man. And there are no other Republican candidates waiting in the wings to take his place for a thankless job. So all that needs to happen, and I think this is what, some of the publications out of DC are missing, is Hakeem Jeffries, the new minority leader for the Democratic caucus, who's done a tremendous job keeping his caucus in line so far this year, can allow his members to just vote present. And it is a way for Democrats not to signal their support for Speaker McCarthy, but to force the Freedom Caucus to show that they do not have a majority and are not capable of governing the House either. So I think this motion to vacate piece is underappreciated, how small the force the Freedom Caucus actually has. Frankly, I'd love to see the vote and have McCarthy come out and sort of shut them down. The faster that happens, the better.
Henrietta, I just wanted to finish on this, the quote from the UAW president yesterday. We were looking forward to getting your reaction to that. I'll share the quote again, that every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. What is this going to look like month end in Detroit when on September 27th, the former president is talking about visiting, and at the same time we have a second debate for GOP candidates?
I think it's going to be fascinating to see Trump maybe not show up for those debates yet again, and see if there's fractions between the Republican presidential candidates to see who wants to support the labor unions, who wants to support the auto industry, and who doesn't. That was a huge deal. We talked about this last time. I made an ill-timed joke, but Mitt Romney ran on the campaign platform of the auto bailout was not a good idea. The last time auto workers really embraced a Democratic president and their sort of true star was Obama and the auto bailout. So I think the Republican Party has a very tricky narrative to define here, and Biden continues to be at the table. I don't know that they're moving the needle yet. And to your point, I think that the strike very well could be still going on. But Trump is going to have to walk a fine line that alienates a lot of the Republican platform here, especially with government staying out of business.
Yep. Henrietta, thank you.
Fantastic.
Henrietta Trays there of Vader Partners. Coming up next on this program, Jonathan Pingle of UBS and a new call from Nomura on why they think this Bank of England is on hold tomorrow. Details of that call up next.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Need a countdown clock if we don't have one already. I think we're 5 hours and about 30 minutes away from a Federal Reserve non-decision, unchanged as the call. Plenty of action expected in the forecast for this year and next. We'll talk about that in just a moment with Mike McKee in Washington, D.C. Equity futures on the S&P just about positive by 1/3 of 1%. We're higher here on the S&P and the NASDAQ up by 1/4 of 1%. The Russell higher by 1/2 of 1%. Talked a lot about the calls coming out of Bank of America. Savita Subramaniam now looking for 4,600 year end, just a couple of percentage points higher from where we are. That call up from 4,300 previously. A couple of revisions there, a couple of revisions from elsewhere as well. BNP Paribas, big bear, Greg Bowdle, throwing in the towel on that bearish call a little bit earlier in the last couple of months. Outside of equities in the bond market, 2-year, 10-year, 30-year, a rally on the 2-year in the UK, a bit of a rally on the 2-year in the US. We're down 2 basis points, 5.07% on a 2-year. We're looking at cycle highs at the front end of the curve, cycle highs on a 10-year at 435. All of that going into the Federal Reserve, Tom, tomorrow.
There was some real jumble here, and Alberto Gallo was shocking there, particularly on EU distress. John, verbatim, David Rosenberg up in Toronto. We take the view that we just experienced phase 2 of an extended bear market rather than the beginning of a bull run. Phase 3 still lies ahead of this. That's from the great disinflationist David Rosenberg.
Let's get to the UK.
Some of the caution there.
The pound, 123.70. Tom Goldman says we're done. The Bank of England is done. Nomura out with their call. This is Mr. George Buckley. He says the Bank of England is on hold tomorrow after the big surprise in CPI today. So we thought downside surprise on inflation would mean potentially a coin flip. Nomura says no hike. Goldman says no hike. The pound's a little weaker, 123.70 on sterling. Jordan Rochester over at Nomura, George's colleague, looking for 122 and staying short sterling.
And is it a stagflation-y lesser growth, as David Rosenberg alludes to there indirectly with his equity market call? But, you know, here's this trend off of data. I guess it's data dependency. But it really harkens to then how does it fold over to the growth call? And
this is what Avsalinios said, and Lisa mentioned this earlier this morning. I think it's a really good point. If you get a better growth profile because these central banks back off, is that sterling positive or sterling negative?
That's the ambiguity of it.
And she said it was ambiguous.
That's the mix. I'll go with the ambiguity of it. Let's do this. Let's dive into this Fed meeting. We'll again have our full coverage from London this morning and from Washington. Michael McKee is Bloomberg International ambiguity correspondent and joins us right now. Mike McKee, for Jerome Powell today, what is his chief ambiguity?
The fact that the Fed doesn't know what's going to happen going forward, which sounds silly because nobody can predict the future, or as Yogi Berra said, predicting is really hard, especially about the future. But there are a number of things on the horizon that could really mess up what the Fed's forecast for interest rates would be going forward. You've got the UAW strike, for one thing. You've got the war in Ukraine, oil prices, the student loan payments coming back, Russia's war in China's economy. So there are a lot of things they don't know what's going to happen. So the best case for them is probably to sit tight. I don't think they're going to move rates. Nobody really does. But then the question is, do they change the dot plot? Do they suggest that they don't need to cut more? Right. And I don't think they'll do that either.
Mike McKee, Fed tradition is you get the last question because of your power, grace, and heritage. If you had the first question today to Jerome Powell, what would it be?
Well, I think a logical first question, although I don't know it would be asked, is how much confidence do you have in anything that you're telling us today? Because there are so many possibilities for things to go pear-shaped that you have to wonder if people could put much stock in what the Fed is forecasting. I think John was making a good point before we came on here when he was talking about the pound. Currencies are probably going to be where you see the reaction this week. On Friday, the dollar's been rising. And is it going to still be rising after the Bank of England makes their decision and after the Bank of Japan makes their decision, and both of them following the Fed? We may be kind of at a bit of a turning point here, and the Fed may become a little bit less relevant.
John, I think we just saw there why McKee gets the last question.
I'm going to suggest
and not the first question.
Might be why Mike McKee doesn't go first in that news conference, particularly if Mike's planning to ask that a little bit later in the presser. Mike, Citi published early this morning. I'm sure you saw the work of Andrew Hollenhorst. He offered up 3 points, 3 stories, 3 dimensions to the inflation debate. He said oil prices, UAW strikes, and house prices. From your perspective, Mike, how do you anticipate Chairman Powell will navigate those 3 issues?
Well, oil, for the moment, he's got to say we looked through that because we don't know where oil is going and for how long. And we can't lower oil prices by raising interest rates. If it went on for a long time and inflation expectations got unanchored, then the Fed might want to do something. But they're going to put it in terms of the inflation expectations. As far as house prices, they know they've been rising in recent months, but the house prices take a long time, as we've said, to get into the economy and into the data. And right now, it looks like what we're seeing is still declines from the declines that we had over the past year or so. And finally, when you look at the UAW strike, again, that's going to depend on how long it lasts. I would have added the government shutdown, because if the government shuts down, there could be a lot more people along with the UAW if it broadens the strike who are on unemployment benefits. And that could mess up the numbers both for unemployment and employment and make it even harder for the Fed to know what's going on.
Payroll's a few weeks away. Mike, thank you, sir. Mike McKee, he's going to be with us a little bit later, breaking down this decision and all the forecasts as well at 2 p.m. Eastern Time. Our special coverage begins at about 1:30 Eastern Time. A 30-minute drumbeat into the decision, some 30 minutes of analysis going into that news conference, a special 1-hour program hosted here in London. Just a programming note, tomorrow, we are here for our Global Credit Conference here in London. Tomorrow we'll be catching up with Apollo's Jim Zauter joining Bloomberg Surveillance, especially for that conference, Tom. So
and after the Alberto Gallo conversation, that's going to be an incredibly interesting conversation. And the ascent of private equity, private companies, and that, the Zauter conversation is going to be important.
Stagflation, the word that Alberto used for both the UK and Europe. And then he said the prospect of re-accelerating inflation in the United States and the difficulties invested around that.
All the different narratives we've got right now. Let's begin our Fed coverage for this afternoon and into the London evening with Jonathan Pingle, Chief U.S. Economist at UBS. Jonathan, on this Fed, I'm making jokes. It's a snooze fest as we lean to November and December. And as you say in your research note, we are completely data dependent. What data is Mr. Powell dependent on?
Well, yeah, thanks for having me, Tom. I mean, I think first and foremost, obviously, I think it's really the inflation data. And I think this is actually one way in which, you're talking about ambiguity, that Chair Powell today is not going to have the old Chairman Greenspan-like ambiguity. He was pretty clear at his Jackson Hole speech when he laid out the conditions for raising rates further, said they were prepared to do so if appropriate, and all three of those things were related to inflation. One was inflation fails to improve as much as they expect, growth is too strong and puts the improvement in inflation at risk, or the labor market remains too tight and puts the inflation improvement at risk. So I think if you had to think of the summary statistic for Chair Powell and the data, I really do think it's the inflation data.
You survived working with fixed income at BlackRock. For an economist, that's always sport to say the least. Link your world and Jerome Powell's world into what we're going to see in interest rates off this meeting.
Well, I think, going into this meeting, based on, sort of the conversations we've had and our strategists, that, it does seem like a lot of the commentary has people setting up for a hawkish skip or, some sort of incrementally hawkish message here. I'm not actually sure that's really going to be the case. All of the information they've gotten has been pretty positive, actually, since the June meeting, since the July meeting, what they got in the quiet period. I mean, inflation's falling much faster than they had written down in June. Non-farm payroll employment has slowed, quite substantially, but still healthy. But it's really gone a long way towards slowing the way they want it to. And right now, after the CPI and PPI and the other inflation data, we're tracking August core PCE inflation at 3.8%. That's already below their full year 23 projections from the June summary of economic projections. So for the FOMC participants, it does look like they've gotten a lot of good news on inflation without the economy really rolling over. So it looks to me like they're in a pretty good spot with inflation falling faster than they expected.
Well, Jonathan, three-part story today, as you know: statement, projections, news conference. Would you expect then, and I think this is what people are anticipating, maybe a little bit of a Goldilocks soft landing assessment in the statement, perhaps the forecast, but ultimately in the news conference, that vigilant, more hawkish stance you might get from Chairman Powell? Would that be the three-part act you're looking for?
Yeah, I mean, I think the statement is going to have some changes, but I think the real action is in, as you say, Jonathan, it's going to be in the SEP and the dot plot in particular, and then how Chair Powell frames it in the press conference. I don't think the SEP is going to be quite as hawkish as a lot of the the projections that are circulating around. But I do think in the press conference, Chair Powell is going to say that they are remaining vigilant. And just like he said in Jackson Hole, I think he says the committee's prepared to raise rates further if appropriate. But I don't think he's going to commit to raising rates further. I think at this point they are very data dependent. They're willing to watch the data come in. Inflation's been better than expected. I think they're in a pretty good spot right now. I think they're generally pretty happy with what's unfolding.
When someone stands up in the news conference and says, Chair Powell, look at gasoline prices, look at commodities, look at energy, what do you think the pre-prepared answer he has in front of him is?
Well, I don't want to undo Mike McKee's genius here, but I mean, I do think they're at a point right now where they're going to look through it and wait to see if it's a more sustained move higher. We've had a couple of periods where, Brent has pushed up to sort of $88 a barrel since November, now it's sort of pushed above 95. We'll see if it stays there. One of the problems they have with the energy prices at this time, they do know that if it just stays there for a year, inflation's a growth rate, so the inflation will go to zero. So far, it looks to us like there's only going to be modest pass-through into core, like pretty minimal, and I think that's going to be their assessment for the moment as well. So I do think that, they're going to look through it and wait to see if it does threaten the progress on core inflation. And as Mike McKee noted, the big thing for them is going to be watching inflation expectations, which thus far, the most recent incoming survey and other data has looked pretty good.
We'll see if Mike McKee's allowed in the news conference a little bit later. Jonathan, thank you. Jonathan Fingal of UBS. Appreciate it, John. Good stuff as always. Thank you very much, sir. Mike McKee will be in that news conference a little bit later. If you are just tuning in, welcome. The S&P 500 positive here by 0.2%. Yields going, let's say, absolutely nowhere. 434.87, but in the last 24 hours, cycle highs basically at the front end and on the 10-year. On the 2-year through 5% still. On the 10-year in the 430s, on the 30-year in the 440s. Yields are elevated here, Tom. going into this one with Chairman Powell and the Federal Reserve.
It's a moonshot. They're not elevated. They've been going straight up like oil has gone straight up. And I think this goes back. The thing I would do, John, draw the horizontal line from where we are now on any of those yields. And you go back, and the answer is it's not August of 07. Maybe it's 08, 09. Maybe a few selected ones are back into 07. But Chairman Powell goes into this meeting with a rate regime from our youth. That was a long time ago.
Is that where he wants it to be?
The question, I'm optimistic about that. We've had a lot of optimists on the shows. Ben Laidler starting us off today.
Max Kettner, another.
And the answer is we adapt and adjust, and corporations adapt and adjust to that rate. It drives people nuts. Paul Krugman says we're in a disinflationary trend, and we will be with good comparisons going out. People get upset because they're looking in aisle 7 at their grocery store going,
Things
I don't,
expensive.
you know, I'm sorry, this
you
is
and
what
I
it
are on the
costs.
same page about this.
Yeah.
You can't just strip out the things you don't like, energy and food prices, and say, well, look at this, it's not as bad as you think it is.
Yeah, some breaking news here. This is Zeppelin Foundation, I believe it's called ZF in Tuscaloosa, Alabama. It's a UAW organization and strike. This is Mercedes high-end chassis. But that's that geography of this UAW strike. Is that what we're going to see on Friday?
How much more of this will we see announced by the UAW president at the end of this week on Friday in that Facebook Live event? From London, Mark Cudmore up next.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Looks like you're going to have a divided committee. We're on the side of them still having the median voter with a dot, but it's a close call. I think regardless of that, and regardless of big changes in the forecast for 23, the 24 forecast is still going to have something close to 100 basis points of easing. It's still going to have a big drop in inflation. It's still going to have an aspiration that we get an unemployment rate up to 4.5% without a recession.
That line there was brilliant from Bruce Kasman at JP Morgan, the head of global economic research. An aspiration. He didn't call it a forecast. He called it aspirational. More on that a little bit later on when we get that Fed call and those Fed aspirations, if you want to call them that, in the summary of economic projections. Equities right now going into the opening bell about 43 minutes away. Futures elevated, positive by 1/3 of 1% on the S&P. Plenty of price action in the commodity market over the last week or so. New highs for the year, 95 on Brent. We're back away. WTI still just about in the 90s, backing away by about $1 full. We're down about 1.1% on the session. The headline, though, in the bond market. And I have to say, Tom, it's hardly made any headlines. The fact we're in cycle highs in the last 24 hours.
I agree.
On a 10-year maturity, on a 2-year. Yes, we've backed away from those levels, but shouldn't we be talking about this a little bit more?
I think we should. I mean, the bond market's there, and a 5.09 in the 2-year yield is there, and I'm going to watch the real yield coming off the Fed meeting. And frankly, as you mentioned, with Nomura and Goldman Sachs going on Bank of England rather, the Bank of England to a no rate change or a hold. I'll let them nuance that. It's hugely fungible right now, and it makes it for a very interesting Fed meeting this afternoon.
The Goldman say no hike tomorrow. Nomura coming out in the last 10 minutes or so saying no hike tomorrow.
Yeah. We had a listener and a viewer email in. This is Guy from England. And
Guy Johnson.
Yeah, he said, you know, there's enough football talk, and we did AC Milan and the rest of it, but we've got to really focus here. He wants equal opportunity at the Decathlon Saint-Denis Stade in Paris this coming weekend. Why don't we talk rugby, John? I mean, you taught me about English football
I was a terrible
and
rugby
Formula
player.
One.
That's why I don't talk rugby.
It's huge here. It's like, you know, it's like on TV. It's like there's like a world champion here.
It's a big deal.
We go to surveillance rugby correspondent Mark Cudmore, who joins us right now. Before we get to bonds and all that, you're in Singapore, and you're looking at rugby worldwide, and you've got Ireland, South Africa this weekend. Explain the majesty of that to you as an Irish lad.
This is just absolutely immense. Ireland is very rarely the #1 ranked team in any team sport. We don't have a big enough population. We are #1 ranked in the world. We're on, I think it's a 15-game unbeaten streak. We've beaten all the other major nations when we've last played them. What's the catch? Well, even though we were Grand Slam champions earlier this year as well, the catch is we've got knocked out of every World Cup at the quarterfinals. We've never got beyond that stage.
Because New Zealand's in the way, right?
I'm not that worried about New Zealand. The All Blacks aren't as intimidating as they once were. Right now, it's South Africa and France I'm worried about. The South Africa pack is just so strong, and France have home advantage. So really, I think that Ireland have a great chance, but it's between those three teams. I'm not counting the All Blacks as serious contenders.
Let's continue. Anything intimidating about these central bank decisions in the next 48 hours?
I'm a little bit disappointed we're switching away from the rugby, but I do need to correct you. 2-year yields are not at cycle highs.
On
I have
a closing
vested interest in this.
Cycle high,
At the closing basis. But I have a vested interest because I've actually swiveled my view, because the last couple of years I've been very adamant that yields go much higher, and I kind of really pushed back in the early premature Fed pivot idea because everyone was underestimating the consumer. But now the US consumer is finally going off a cliff. So all those people who were trying to call a recession way too early are now suddenly abandoning their recession calls, talking about soft landing at the exact point when the consumers go off the cliff. So I've just recently changed my view on 2-year yields, which is why I have a vested interest in saying it hasn't yet broken that peak of 5.12%
oh, Mark, you're killing
on
me.
an intraday basis.
On a closing basis,
I accept.
Cycle high. Okay, 10-year, cycle high. Okay.
Closing basis, I'll accept.
Sure. I think intraday, cycle high on a 10-year.
Yeah.
Thank you. Okay, we can move on. TV doesn't have to be this hard, does it? Does it?
Let's cut more. You know, what do you want?
All right, Mark. Let's move on. What are you looking for?
So out of the central bank meetings, well, because I think that the yields have peaked. I think the price action around that has been very, very kind of impressive at the front end. I do think we'll continue to see the curve to steepen. So I think what we're going to go into is the Fed will probably hike once more this year. I think that's out. And I think the 2-year yields can survive, peak, can survive even another hike in November. They just can't survive if we get a hike and then a promise of more hikes to come. But I don't think that's going to happen, because I think in line with Bloomberg Economics, I think Anna Wong is the best US economist out there. And she has highlighted all along that there isn't going to be a recession all the year, rest of the year, when everyone else is calling it, but the consumer is going to go off a cliff. Starting at the end of the fourth quarter, we'll get a US recession. Yields will come lower. Now, I don't think the Fed actually tonight is going to be the instant catalyst tonight, but what I think is going to be interesting is everyone is geared up. Not everyone. Most people are geared up for a hawkish Fed, which is why we're at the cycle peak in yields on a closing basis right across the curve, John, is because they're geared up for a hawkish Fed. Therefore, I think the bar to surprise hawkishly is very high. So ultimately, I think the price action after this is yields come lower and the dollar turns lower into year end as well.
How does the Cudmore world focus into equity markets? How do you filter bond dynamics down to the equity call?
Yeah, that's a really good question. So I think if you think...
I flunked at rugby, but we're killing it on the equity.
I preferred the rugby one, actually. But, I think if we're going to get... So normally 2-year yields peak a couple of months before the start of a recession, and US equities are actually less of a good leading indicator. We had the recession post-World War II, where US equities rallied all the way through it. They're not always a consistent leading indicator, but they normally, with a low statistical significance, they have a median lead time of 2 to 3 months of when the recession starts. Right. So if you think a recession is going to start in fourth quarter, you should be looking for a peak in the US equity market around September, October, and that's what I've kind of been talking about. I made the mistake last year of thinking US equities would underperform. I luckily capitulated on that very, very wrong call in March. Since then, I've been bullish. I haven't yet turned bearish US equities, but I'm looking for that turn. And I wonder whether I've already missed it. Maybe tech is already showing that the turn is already there, but I think we maybe get one more high.
What are the ramifications if the Bloomberg total return, I look at the US aggregate total return index, if price comes down and breaks through to a new lower price of aggregate debt with a higher yield? Is anybody prepared for that?
I mean, no more prepared than they have been for the last few years. You've probably seen it for all your guests. I've seen it for all my guests on the morning shows that everyone wanted to be long duration. Even though I think 2-year yields are going to come lower because I think the economy is going to turn south, I think we're going to continue pricing back in the term premium. We're going to continue pricing in normalizing bond markets, the bond markets that have been distorted and broken for the last 15 years, and that because the fiscal supply next year is going to continue going up, and we're not going to curtail fiscal deficit, especially going into an election year with the economy slowing. So I think you're going to see a lot of yield curve steepening over the next 6 months, quite aggressive yield curve steepening. I think that's a big
John, I think we're completely unprepared if we get this low probability outcome of price down through the low price, high yields of 12, 18 months ago.
Great call from Priya Misra at the start of the year.
Oh, yeah.
That's just fantastic. Inversion all year,
absolutely.
Which is basically where we've ended up. Got a few more months still to go. Mark, thank you. Good to see you. Your equity market on the S&P, positive by 0.3%. Going into 3 big central bank decisions. The Federal Reserve a little bit later on this afternoon. On to the Bank of England tomorrow. Latest call from Goldman and Nomura. No change, they're on hold. The Bank of Japan on Friday. Tune in 1:30 Eastern time for a Bloomberg surveillance special, The Fed Decide. We'll be joined by Kathy Jones of Charles Schwab, Matt Lazzetti of Deutsche Bank, Diane Swank of KPMG, Andrew Hoddenhorst of Citi, Tom, looking for that interest rate hike, again from the Federal Reserve in November, together with a team over at Bank of America.
Yeah, we start right in tomorrow. It's going to be fun to be here for the Bank of England decision. Do you and I get to stand out front of the Bank of England,
Would you like to do
Lizzie
that?
does?
We can do that with Lizzie.
You know,
We'll
stand out front, I can wear a Burberry trench coat. And,
You've never done that before?
I've never done that.
There's a lot of traffic that used to go by, but now they're trying to pedestrianise that area a little bit, aren't they?
Okay.
You noticed that?
Very
All the bikes going past. We can
These are not small matters, and I don't agree with some of the zeitgeist. Japan's off the map with yen at 147, 148. I think that's a germane story for Western investors.
Dollar strength. It's been a big issue. Mike McKee was talking about that, TK.
Yeah.
Is that about the rest of the world, or is that about the United States?
Both. It is about, to begin the morning, as we did here in London with Ben Laidler, it is about that long-duration innovation play, and of course, we heard that from Kathy Wood as well.
I love what Bruce Kassman said over at JP Morgan today, referring to their forecast as aspirations. Remember Diane Swank talked about that over at
She'll be with
KPMG?
us this
Same
afternoon.
thing. Same thing.
It'll be the same thing. What I would really focus on, and this goes into all the different narratives and opinions that we have, is this is still original territory. We forget we're coming out of a pandemic. I happen to believe we're seeing still pandemic dynamics. We're not free and clear of COVID, forgetting about the new booster debate and all that. But it is original economics that's going on now, and because of that, each and every of these 3 banks are going to say the same thing. We're data dependent.
Line of the morning, Mike McKee. How much confidence do you have in anything that you're telling us today?
Yeah.
His question in the news conference with Chairman
question.
Powell. How do you think that's going to go in that news conference with Chairman Powell?
He goes in with 16 questions, and they all start in. They don't want to go to McKee. Everybody in the press conference has like an official name. And at the end, it's Mike.
Mike, what have you got?
What do you got?
Until last. What do you
He
have?
goes through his list of questions, his tree of them, and he asks them, have you been to a Dead concert recently or something?
He has been to a Dead concert, right? In Washington, Mike McKee breaking down that decision for you at 2 p.m. Eastern Time. Special coverage starting at about 1:30. From London, for our audience on TV and radio, thank you for choosing Bloomberg. For our audience worldwide, this was Bloomberg Surveillance. Equities are up. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
From New York City for our viewers worldwide, I'm Matt Miller, in for my friend John Farrow. We're looking at actual movement in the markets ahead of a Fed decision. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Chair Powell in focus with the Fed rate decision on deck. Treasury yields pulling back from the highest levels they've hit since 2007 as markets face mounting headwinds out of Washington, D.C. We begin with the big issue, gearing up for a hawkish pause.
The Fed will do what we all expect it to do.
So they'll pause.
Pause.
Hawkish pause. A hawkish pause.
The pause, but an indication that they're prepared to do more.
They'll keep wide open the possibility of another hike.
Leave the door open for a November hike.
I don't think they can say that are done. They're going to remain vigilant.
They'll make it very, very clear that they are still data dependent.
And they're going to push back against this notion that they'll be cutting anytime soon.
The big question mark is, are they going to do something in November?
What do they do November 1st? Their next meeting.
I think that the Fed is done hiking rates.
We see inflation coming down.
They're going to raise rates in November.
The economy is still very strong.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
Whether they hike again in November is yet to be seen. November, we'll see what happens.
Joining us now to discuss is Kathy Jones of Charles Schwab and Troy Gajewski of FS Investments. And you know, before we get to what's to expect out of the Fed, or maybe that is wrapped into this, let me ask you, what has driven yields so high? Really across the curve, I think except for the 20s and the 30s, we've seen 2007 highs. Let me start with you, Kathy. What's pushed us there?
Yeah, the term premium, that risk premium that you get for locking in yields longer term, that's pushed higher. partly because economic growth in the third quarter has picked up and expectations for the next Fed rate cut have been pushed out into the future. So we've seen real yields really move sharply higher, and that has been the driver here, not inflation expectations, but real yields. I think they're about 2% on the 10-year now. That's the highest they've been since about 2007. So that's really been the big driver behind this push up in yields.
Troy, what do you see when you look at this yield curve and we're awaiting a Fed decision that could really signify the end, even though we're expecting a pause, the end of this rate hike cycle? Is it time to buy?
Yeah, we think you want to be still very cautious on duration. To Kathy's point, so much of it's been driven by the recent stronger economic growth and obviously inflation indicators, whether you look at owner equivalent rents or oil prices, are starting to tick back to uncomfortable levels. And then the flip side of that, of course, is, the supply. When you look out, months and quarters and now 5 to 7 years, there's going to be a never-ending supply of treasuries at a time where the Fed is still doing very, very aggressive QT. So whenever you have a yield curve that's still this incredibly inverted, it's very difficult to argue you have great risk reward in duration. And our main message to people when it comes to duration is not that you don't have upside in the next downturn, because clearly in the next economic downturn, at least the 10-year will go to 3 to 3.25 as the Fed cuts to, approximately 3% in the front end. It's just between now and then, you can experience substantial pain, as we've seen recently through bear steepening price action. And with the economy running as hot as it is, that looks as likely as yields have peaked. So it's still a tricky place to be. Duration has continued to disappoint investors. And the great news now is there's so many alternatives that can benefit from higher income for longer, particularly those tied to floating rate exposures.
Troy, can you, qualify how aggressive this QT really is? Because critics have called it quantitative drip here. We're still at $7.5 trillion, right, in terms of the Fed balance sheet. They've raised rates 525 basis points over the past couple of years, and we've still got inflation that's double their target, with unemployment that's well below 4%. So it doesn't seem like it's been that aggressive, at least in its results.
Well, look, some would argue that last year's outcome for 60-40 was quite painful, especially if you were overweight, growth stocks. And part of that was obviously driven by a transition from a massive balance sheet expansion, unprecedented, to a very aggressive QT program tied to aggressive front-end hikes. So, this is only the second quantitative tightening, so there isn't a lot of history to compare it to. But, the Fed is progressing at 4 to 5 times the pace of balance sheet reduction compared to the 17, 18, 19 experience. So much more muscular. But to your point, when you look at how much the balance sheet expanded, they've only taken 10 to 12% of that off relative to where it was at the peak. And they still have a very long way to go to get that balance sheet around to the 5 to 6 trillion range, which is what they've articulated as their end goal. So when you think about what that means for broader liquidity, remember, there's only 2 ways to create money, right? Either the banking system lends aggressively, which clearly is not happening. The banking system was already pulling back prior to, the bank failures, or the Fed prints it. And so we're in an environment for the foreseeable future where money supply growth, if it grows at all, would be a victory for the Fed. But it's certainly not going to grow faster than nominal GDP. So you're not going to have excess liquidity to drive asset prices higher and higher like you had from most of the 2009 to 2021 period for the economy and markets.
All right, so it's still, it's a really fascinating situation in that case because they've done so much, and certainly in markets we've seen an effect, but it feels like in the economy there's still a lot to do. PIMCO's Geraldine Sundstrom weighing in on the November debate, not today's meeting, but November's, says, quote, there's still a fairly elevated chance of another hike before year end. Higher for longer is likely the mantra for U.S. rates as inflation will remain a little bit stickier than expected. Kathy, what do you expect out of today's dots and SEP?
Yeah, I think we're with the consensus. We might see a little bit of a shift in the dots. Last time we had 12 dots indicating another rate hike. That may come down just a little bit, but I don't see that the consensus will shift very much. And then the focus is really going to be on, as we go out into the future, are we going to push out those expectations for rate cuts into 2024? I think that that's a possibility. And then there's a small chance that there's an adjustment in the very long term, the terminal rate. You might see a couple of members shift up that dot a little bit. I don't think that that's a high probability, but it's something people are keeping an eye on. In the SEP, they'll have to revise up the GDP numbers based on third quarter bouncing up, but I don't think for the year there'll be a huge change in the GDP estimates. And keep in mind, it feels like the economy is really buoyant because we've had some good numbers in the third quarter. We've been below 2% real GDP for 4 or 5 quarters on average. So we have slowed the economy down. We are seeing the unemployment rate move up. I think the Fed will have to adjust, near-term unemployment down, but stick with a longer-term unemployment rate rising. So it's going to be a mixed bag, but I really think that we kind of have to push back against this notion that the economy is running on all cylinders. I think it might be running on fewer cylinders, because I know you're a car guy.
Yeah.
Fewer cylinders. They're not all firing at once the way they were, during the immediate post-COVID period when we had all that fiscal stimulus.
Maybe it's battery powered and we just can't find a charger right now. A Fed rate decision, obviously, really the focus all day long. That'll come out at 2 p.m. Eastern. Reminder to our viewers. Of course, it's followed by Chair Powell's news conference that comes 30 minutes later. You can watch Tom, John, and Lisa on A Fed Decides. It's special coverage this afternoon. And, of course, Mike McKee, a very important part of that, Bloomberg's international economics and politics reporter. Joining us now from Washington, D.C., he's got a preview of what we can expect. Mike?
Well, Matt, we're going to play a game here to make the 2 o'clock announcement more interesting because everybody knows the Fed's not going to do anything. First part of the game is the word finder. Take a look at the statement and the part of the statement that has said in determining the extent of additional policy firming that may be appropriated. If that word additional stays in there, they're still thinking about whether they need to raise rates one more time. Second part of the game, count the dots. Kathy brought this up. There were 12 dots predicting a forecast of another rate hike in June. Does that come down today? Do fewer people think that there is still going to be one more rate hike, or do they take it out? We'll have to see. And then look at 2024. The consensus was the Fed funds rate would fall to 4.6%. Does that change? Do the dots move down or up on that? Do they take out some of the cuts because maybe things are strong? And finally, let's do math. Kathy was talking about the GDP numbers. It's the inflation numbers you want to watch in their new summary of economic projections, because if they raise the inflation rates, then they're signaling they might have to do more. If they lower what they think is going to be the inflation rate for next year, especially, then they might have to do less. There probably isn't going to be a clear winner in this game, Matt, but it is some way to look at what the Fed is doing. A lot of short-term issues in front of them that they don't have the answer to. And so get back to my question that I told John Farrow I'd ask. How much confidence do you have in what you're forecasting today?
And what do you want to telegraph, Mike? Because I thought it was really interesting. Anna Wong, Bloomberg Economics chief U.S. economist, her base case is for the Fed to put a dot in there signifying another rate increase coming this year, but then not to do it. So essentially kind of jawboning, I guess, the effect of another rate increase until the end of the year, and we realized they didn't actually act on it.
Well, it's keeping their options open. The markets would react badly if they took the dot out and then had to come back and raise rates. That would be a surprise. If you leave the dot in and don't do it, that's not going to bother people too much.
All right, dots go is going to be a big focus today. Mike, thanks very much. I know you're there for the long haul throughout Fed Decides today. JP Morgan's chief Japan equity strategist sharing her outlook for a different central bank, and that may be more interesting. Globally, we're waiting for the BOJ. What does she say about their path ahead?
JP Morgan expects that BOJ policy step after YCC tweak in July. Next thing would be the YCC removal in early 2024, and then in mid-24, the removal of negative rate.
All right, so we have the BOE and the BOJ to follow. The BOJ, I think surveillance polled their guess apparently was going to be the most interesting meeting. Now the BOE is also fascinating because of the little drop in inflation that they showed. But Kathy, what are you looking for in terms of yield curve control? Could this be a game changer?
Yeah, it certainly has potential to have a pretty big impact. You know, we've been saying for years that the one thing that can change the outlook is if Japan eventually ends yield curve control. And it looks like it's coming. It's on its way. So that sets up a dynamic where you get perhaps less demand for U.S. Treasuries versus others. But keep in mind that, you know, the market is already starting to adjust to this, and much of the anticipation is probably already built into where JGBs are trading. So I think it's a short-term effect over the next 6 to 12 months, perhaps, but going out longer term, I don't think it really changes the dynamic of the, you know, the global market. So we have a bunch of central banks still tightening policy to try to slow inflation, and you have one central bank kind of edging in the other direction. I think the sum of that is, you know, it sort of equals itself out, but obviously a lot of volatility along the way.
All right, Troy, just want to quickly get how important other central banks are on your radar. I'm told that our economies are interconnected.
Yeah, I mean, I think when push comes to shove, you know, the Fed still has been and always will be the most powerful financial institution in the world. So, you know, it's not that every other central bank's a sideshow. To Kathy's point, they can have marginal impact. But imagine a scenario where yield curve control stayed and the Fed hiked by 50 more basis points. Like, what's going to dwarf the other? And so, you know, we obviously talked a bit about the risk to duration. But I think what is now an incredibly favorable scenario for investors in this environment is this concept of a dare to dream scenario, where if you're invested in floating rate debt, that's typically tied to speculative companies. In the case of commercial real estate, you know, you're senior secured in the capital structure. We're now in this environment where it's possible that rates stay elevated for years, not at 5.25%, 5.5%, but well above 3 or 4%. And we never have a give back of the income because defaults stay very, very benign as they have so far. Right. So, you know, there's been some negative surprises in this cycle. Clearly, you think of how 60-40 did last year. You think about those that were over their skis in duration this year. But there's been a lot of upside surprises. And one is the continued strong performance of credit and the abundance of income at the front end of the curve.
Yep. All right. I think that's all we need to say about the BOE and the BOJ. We'll continue to focus on the Fed, but let's also look into the equity market. Kathy and Troy are going to stick with us on that, but Abigail Doolittle joins us for a look at stocks ahead of the opening bell. Abigail?
Well, Matt, we do, of course, have futures trading higher. Let's take a look at some of the idiosyncratic winners on the day. Coty shares are popping this after the company did boost their like-for-like sales growth along with adjusted full-year EBITDA guidance on strong beauty demand. Hudson Pacific Properties also higher. This is BMO upgrades to an outperform, saying that the West Coast REITs negative catalysts such as the Hollywood strike and a dividend suspension, well, they're priced in. And then finally, Pinterest popping 5.5%. A recent investor event has spurred some upgrades. Both Citi and D.A. Davidson, Matt, they've upgraded shares to a buy. Investors are taking notice.
Wow, an $18 billion stock Pinterest is. Abigail, thanks very much for that. Coming up, markets facing mounting headwinds out of Capitol Hill.
The UAW strike, we're seeing that, and what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown.
We'll discuss the state of play in Washington next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
There's all these elements that we see kind of on the sidelines that we're waiting to see them flow through the economy. So obviously the UAW strike, we're seeing that, and what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown. It doesn't look like we're going to get an agreement anytime soon.
So markets facing mounting headwinds from Capitol Hill, the Biden administration holding off on a trip to Detroit as the UAW plans to expand strikes on Friday if no deal is reached. The White House writing, quote, given that negotiations are ongoing between the negotiating parties, it is most productive for Sperling and Sue to continue their discussions from Washington and allow talks to move forward, which doesn't sound very promising at all. This as House Republicans barrel towards a shutdown at the end of the month, with hardline conservatives foiling Speaker McCarthy's efforts to pass a short-term spending bill. Representative Ralph Norman saying, quote, we're going to have a shutdown. We believe in what we're doing. The jury will be the country. Bloomberg's David Welch joins us from Detroit with more on one of these kind of twin threats. David, the UAW strike doesn't seem like it's ending anytime soon.
It doesn't. Yesterday, UAW President Shawn Fain said that unless there's some real significant progress, which he didn't define, if that didn't happen by noon on Friday, then he would add plants to the three that he already has on strike. And I would assume they'd be pretty profitable plants, but we'll see who he picks. We'll find out Friday morning. But you know, if he's threatening further action, then he's putting pressure on the companies, and that means there hasn't been enough progress at the bargaining table to get near a deal.
So what are we talking about in terms of, you know, the amount of people who are going to be out of work here and the effect it's going to have on suppliers? Because worst case scenario, or one of the worst case scenarios, is that we get a part shortage and it affects all manufacturers, not just UAW plants.
That's right. And so you did see a strike of a parts plant in the South today that could have ripple effects. But what could happen out of the big UAW strike with the big three is if volumes are hurt enough at some of the plants that supply the big three, they might supply Toyota, Honda, Hyundai, Kia plants in the U.S. somewhere, and if it's no longer economical for them to run, or if they get shut down, then that could have a ripple effect. I don't think we're quite there yet because we only have 3 assembly plants in the U.S. that are down from the UAW strike. But if you add a lot more this weekend, you could see an effect coming out of that.
A lot of these, you know, big three cars are produced elsewhere in North America, Mexico, Canada. Canada has had their own union issues. What's the state of play there, David?
So the union delayed things by a day to see if they could come up with a deal. It's not quite as militant there as it is here, but it's also touch and go, and they're seeing pretty big offers from the UAW or for the UAW in the U.S., and they're going to want something pretty similar.
All right. David Welch there, Detroit Bureau Chief, wrapping up what we're facing in terms of the UAW. Kathy Jones and Troy Gajewski back with us to talk about how the government shutdown could affect things. Troy, what's your take on, well, really both of these threats?
Yeah, so I think if you look at the UAW in particular, I mean, it's part of a broader trend, right, where labor has far more power than at any time, not relative to the 50s and 60s when unions were much more dominant, but in terms of the average worker in such a tight labor market where there's so much labor hoarding. And on the one hand, obviously the strike puts a little bit of downward pressure on GDP growth. But on the other hand, if the union gets anywhere near the wage increases they're asking for, it just makes the Fed's job even tougher to constrain inflation, because ultimately, you know, this is playing out as a mini version of the 70s, where you first have, you know, inflation in goods and services, and then you spill over into the labor market, and you have an all-out wage spiral, which is obviously very problematic from an inflation standpoint.
Right.
You know, in terms of the government shutdown, you know, clearly that's a net negative for risk assets and growth in the short term. But I think the broader point there is if we were right now talking about these risks where equities were 14 times forward earnings, not as big of a deal. If the Fed was not doing QT, not as big of a deal. But we reflated back up to 19.5 times forward earnings, and you have all these issues simmering in the background. So you add a few negative catalysts on top of it, and it could lead to a more substantial risk-off period.
All right, I got to wrap it up there, but Kathy Jones of Charles Schwab and Troy Gajewski of FS Investments, really appreciate your insight this morning. Coming up next, the morning calls, and then later we'll speak to Michael Purvis of Talbacken to discuss the upcoming Fed rate decision. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is the countdown to the open. I'm Matt Miller, in for Jonathan Farrow. First up, JP Morgan downgrading Dollar General to underweight, seeing a challenging outlook amid persistent inflation. And there's a story on the terminal that says it could be the worst place to work in America. Next up, Citigroup upgrading Pinterest to a buy. Abigail Doolittle talking about this, expecting user engagement to accelerate after its investor day. Pinterest is worth almost $18 billion, if you can believe it. And finally, Oppenheimer downgrading Chewy to a market perform, pointing to softening trends within the pet food category, but still not nearly as bad as Pets.com. Coming up, Talbacken's Michael Purvis. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Moments away from the start of trading, you have Klaviyo about to ring the opening bell at the New York Stock Exchange with futures higher on the S&P up about 0.3%. Sigma Lithium ringing the bell over at the NASDAQ. There we go. Trading is started. Let's take a look at not just what futures show us, but some other asset classes here. The euro right now trading at 107.05 as we wait for the Fed decision and then later the BOE and the BOJ. The 10-year yield at 432.87 right now, but it had hit the highest level since 2007, as had a lot of other tenors across the Treasury's curve. NYMEX crude coming back a little bit, down to $90.49 a barrel. Now, in terms of stocks, I mentioned Klaviyo as well as Sigma Lithium, but one to watch is the IPO from yesterday, Instacart, the grocery delivery company, fading after going public in one of the year's biggest listings. One Needham analyst writing, quote, "We see a balanced risk-reward reflecting slowing growth in the years following a pandemic-driven demand surge, and Carts," that's his ticker, C-A-R-T, Carts already scaled advertising business. Abigail Doolittle has more on Instacart. Abby?
So it seems as though we're now having a bit of a trend here, Matt, because Instacart is clearly not the only stock to have gone public over the last 2 weeks. We also had ARM, and both of these companies, these stocks, popping on the first day of trading. Now, relative to Instacart, yesterday it was up as much as 43%. It closed up 12%, not so shabby. Right now, down about 4%. So some of that speculative trading action that occurred yesterday, some of that excitement, it's dying down today. We saw that last week with ARM. ARM closed up 24% on its first trading day, and then the 3 subsequent days, not counting today, last time I looked, it was about flat, down 4 to 5%. So this is a lot different than some of the pandemic darling IPOs that we saw, such as Airbnb up 113%, Bumble up 64%, Affirm up 98%, Poshmark up 142%. This is positive, but when we put it into the perspective of when the IPO market was truly healthy, we still don't know. So, of course, as you were mentioning, later today, Klaviyo will be going public. Let's see how it does. Birkenstock is filed. And I would also make the argument that we still have the Fed out there. If they are in hiking mode, that makes these IPO, these growthier, more speculative investments, a little bit more risk is attached, plus inflation, oil on the rise. But everybody's hoping that this IPO window has opened up. Back in 2021, 976 companies went public. This year, it's basically a trickle. This is all about 2024. Is this going to grease increase the runway for next year for a strong IPO market. I think we're still in the discovery phase, Matt, especially as we have Instacart down 3%. Not so shabby, but it could be better.
Yeah, absolutely. Still undecided. We have a few months left to go, but I don't think that these IPOs represent, a huge window opening for the rest of the industry. Abigail Doolittle, thanks very much for that. Let's turn now to banking. Goldman Sachs in advanced talks to sell its Green Sky unit to a consortium that includes 6th Street Partners. The deal would also include KKR and PIMCO. Sonali Basak, our star Wall Street reporter, has more on this. So David Solomon unloading some of those assets.
Unloading some assets after already unloading some consumer assets. Really, this is a spate of good news for Goldman Sachs that has been trying to clean up its consumer business just weeks away from their earnings report in the middle of October. Now, as you've been saying, they are looking to sell the set of the Green Sky business, which they've already took a more than $500 million write-down to a group that includes 6th Street, KKR, and PIMCO. There's an irony here because remember, 6th Street as well has a lot of Goldman alumni on its own. It has Marty Chavez, the former CFO, Alan Waxman, and it is bringing on Julian Salisbury as well. So a homecoming of sorts. But remember, there is a price for everything. According to the Wall Street Journal, this deal may be around $500 million, a far cry from the $1.7 billion Green Sky was acquired for. But a lot of the cleanup work has been done, in addition to those Marcus loans being offloaded to the likes of Varde and Rhythm, as well as other assets tied to that consumer business. So perhaps David Solomon in mid-October can give investors a cleaner story on the consumer.
All right, we'll be watching it closely with you, Sonali Basak. Thanks very much for that. Let's turn to tech now. Intel getting mixed reviews for its innovation conference after providing a few, or just few, I should say, details about its manufacturing process. The CEO remaining focused on AI, saying, quote, AI represents a generational shift, giving rise to a new era of global expansion. Ed Ludlow joins us from the West Coast. You can tell because he's not wearing a tie and he's wearing shoes for tennis. Ed, what have you got?
Don't deceive the viewer. I'm sitting right next to you, Matt, here in New York City. You know that. Intel down 1.6% on a two-day basis, on track for its biggest drop in a month, having fallen by the most since mid-June in yesterday's session. The AI story that Pat Gelsinger is trying to position with Intel is that the next wave will be on device. Remember, Intel, one of the principal makers of PC processors, and while right now we're focused on large language models with hundreds of billions of parameters, those are built in data centers. The future for generative AI tools will be on local device PC powered by Intel processors. The manufacturing process you referenced is for their foundry business, where Intel is hoping to shift to become more of a mainstay third-party contract manufacturer like TSMC is for much of the world's chip makers. And what we did not hear was a customer for 18A. That is their next generation node or manufacturing process. They are on track to start that process back into 2024, 2025. They've dangled there being a customer in the wings who Intel will make a chip for built on 18A. They've just never named them. And so they're making the right noises. They're talking about their own GPU for AI, which is called Gaudi 2, and how that is going to be competitive against NVIDIA and its H100s. But the ticket we're waiting for is to Intel talking up its foundry business. When are they going to name that customer, and who are the customers thereafter? The stock down 1.8%.
All right. Fascinating stuff. Ed, thanks very much for that. He is sitting right next to me, but you can't tell because we do these shows down the barrel. There's no relationship shots. Turning to earnings, General Mills reaffirming its full-year forecast for 2024. The CEO saying, quote, we delivered growth on top and bottom lines in the first quarter amid an evolving external environment. Simone Foxman here to tell us what exactly that means.
Yeah, that's right. We're seeing numbers that slightly topped analyst expectations, but not by much. The company reiterating its full-year sales forecast, looking for growth of 3 to 4%. That's higher than Wall Street analyst estimates of about 2.8%, seeing adjusted earnings per share come in at 109 to estimated 108. So slight beat there, but the problem is that a lot of this outperformance was driven by price increases, not necessarily growing volume. In fact, volume a little bit weaker than Wall Street had anticipated, negative 2% across its business lines. The CEO talking about moderating inflation, and in a statement said that he expects input inflation to rise 5 to 6% for the fiscal year. This is driven by labor costs. Really interesting considering what we have going on in Detroit. We got more on the consumer as well. increased value-seeking behavior, especially in pet food. They don't expect a huge rebound nor a sharp decline there. We're seeing a little bit of weakness, even though we saw some gains early in the pre-market, but shares down over 22% this year, so maybe it can find a little bit of a bottom. Who knows?
All right, Simone, thanks very much. Simone Foxman there talking to us about GM, General Mills, not the car maker. Getting back to the story of the day, the Fed's rate decision coming up in just a few hours. Talbackin's Michael Purvis weighing in, writing, quote, "The Fed focuses on core inflation because crude and food prices are volatile." I'm glad he didn't use the word transitory. But perhaps they need to be a more important part of the rate policy discussion. Michael Purvis joins us in person now. Michael, great to get you on the program. So why would they want to focus on food and oil prices? Is it because it's one of the only things all of us actually needs to survive?
Well, certainly there's obviously a political dimension to food and oil price inflation here. But, you know, if you go back to 1970 and you look at rises in crude oil, you know, more than 2/3 of the time that if the rise is more than 20%, core inflation increases, and sometimes by a very material way, as much as 1.5% in the coming months. It tends to lead you know, increases in core inflation. Now, if the move is small, say 10%, there's no real statistical evidence, you know, to demonstrate that. But what we're seeing here, you know, since June, you know, crude prices are up 30%. Volatility of crude, which I think is a really interesting feature of this whole crude rally, has actually gone down. And there's an echo in this in interest rates, where rates have been going up, of course, but the rate volatility has been going down. In fact, just last week, we had a new high in the 10-year yield for this cycle and a new low in the MOVE index for this cycle there. And I think those are speaking to the fact that, you know, after so much shock and awe between COVID in 2020 and then the Ukraine war early in 2022, we're sort of post-shock, but we're into these new, the world's contending with these new structural themes that are developing here. And those are moving slower, but they're in some ways arguably more significant. And so I think what we have to, you know, realize is that crude oil is going to help ultimately push up several facets of core inflation there. And then, of course, there's the wage discussion and there's housing discussion and all that. But it is a really important part of the broader economy, and it is lower volatility today as well. So maybe the Fed should kind of blend core and headline inflation more together in their thinking here. This is not about an oil shock. These are about structural shifts with decent demand and tighter supply, keeping oil at the prices where it is. And I think there's a good chance that oil will stay where it is. And if that's the case, you know, next winter, we're probably going to see core considerably tighter, you know, barring some massive external shocks.
I was going to say, unless, you know, there's a recession, and because this oil price, $90 WTI, as I understand it, it's not driven by demand growth, right? So if we have a recession, if people, I wouldn't want this to happen, but lose their jobs and no longer drive to work, or, you know, if they go back to WFH, isn't that going to help bring down the price of oil as well?
Sure, yeah, certainly there. But of course, you know, right now, you know, it's hard to like call for a recession. I think Bloomberg's economist actually is saying that next winter. But you know, we
our
see a
model
high
only
chance
showed
of
a
recession.
100% chance, Michael, of a recession in this half.
But I would say still, I'm not on that page. I think there's a lot of, you know, very strong factors keeping the you know, the economy in reasonably decent shape. Not great shape, but decent shape. All right.
But what? I mean, the consumer's out of money. Not
yet. They're not.
The school bills are going to become due again. More and more purchases are put on plastic. The payments there are seeing a lot more delinquencies. Auto loan delinquencies are just going up and to the right. You know, oil is expensive. There'll be a government shutdown. We've got a UAW strike. I mean, I could go on and on and on. Why do you think this economy is firing on all cylinders?
Well, you know, look at the employment statistics, right? They're still, you know, sort of defying the notion that interest rates were going to crush employment, and they haven't. So, look, Matt, everything you just mentioned, that laundry list of economic bear concerns are all real concerns. But there's also a list of things that are just, there's a lot of important new structural themes that are helping to keep the economy going. But I agree, we're going to see a bit of a downshift here. I just don't think it's going to be something that's going to be that, that big crash landing that so many people anticipated to happen early in this year. I look at it as more of a meh year next year, where a slight degradation in growth and inflation, but still a sort of, I think we're walking into a higher nominal world here. There. And don't forget, Matt, oil prices are higher, but, today the United States is a large oil producer, right? We're there. And what's bad for us at the pump is also good for so much of the Texas economy as well. So it's a very nuanced story here as it relates to the United States.
As they all are. Michael, great to get some time with you. Come into the office next time. Michael Purvis there. He's going to stick with us. Coming up, the IPO frenzy continues.
The fact that we've been able to launch these deals speaks to liquidity in the market, speaks to decent appetite, and those are good fundamental dynamics for the market.
That conversation up next. This is Bloomberg.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing. We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The issue is more around what is the appetite
among investors for IPOs, and to what extent are people looking to deploy risk capital into some of these earlier stage names. The fact that we've been able to launch these deals speaks to liquidity in the market, speaks to decent appetite, and those are good fundamental dynamics for the market.
That was Morgan Stanley's Lisa Shallett weighing in on the IPO market. Klaviyo, apparently it's Klaviyo, making its trading debut today, pricing its IPO above the marketed range to raise $576 million in the third major U.S. listing of the week. This on the heels of SoftBank's chip designer ARM Holdings and Instacart. We were talking about that rally kind of fizzling out the day of and the day after its IPO. Let's bring in Bloomberg's Sonali Basak for more for more of a look, I guess, at this IPO climate. Sonali?
Yeah, when you look at Klaviyo's IPO, for example, you do have not only them hitting above the top end of the range, you have Klaviyo going into a green market. The S&P today up on the day. When Instacart listed yesterday, they did not have the same market heat, although volatility has been low enough to make these listings smooth in a year where IPOs have come to a pretty screeching halt. This is bringing fervor back into the market. Klaviyo has also something that Instacart didn't have as drastically, which is a tie-in to the AI industry more directly. They have come in with cornerstone investors to the likes of AllianceBernstein, BlackRock, and Shopify was an early investor as well here. Interestingly, Matt, you have also had a lot of retail interest in these IPOs. And when you look at Klaviyo today, another interesting aspect of this, Matt, is it's going to price and also list its first trade likely within hours of that Fed decision. So you do have these companies trying to make it to market before any potential volatility were to hit the market and impact risk appetite from investors. Now, we've been talking about this a lot on this program. One day does not make a trend. How these IPOs keep trading will make a big difference, more than there is for Instacart. There are not a lot of grocery delivery companies in the pipeline for future IPOs, but there are a lot of SaaS companies in the pipeline, as Axios points out this morning. And so Klaviyo's listing today, any potential success of it means a lot for those companies in the pipeline, as well as those underwriters. This is a trifecta for Goldman Sachs. And today we also have Morgan Stanley and Citigroup on the listing, as they were not as prominently listed yesterday and last week.
Sonali, thanks very much. Sonali Basak there talking to us about IPOs. Michael Purvis from Talbacken weighing in on the IPO market, saying, quote, after a brutal 2022, the IPO market is coming back to life. The VIX has averaged less than 15 since June. This, combined with strong equity performance, has set the table for an IPO renaissance. Michael Purvis still with us. So what do you think of the action that we've seen this week? Is it going to lure more companies back to public markets?
Look, if the IPO market, if the aftermarket performance here does reasonably well, doesn't have to be great, but as long as it does reasonably well, doesn't fall apart, the market doesn't fall apart, and the VIX stays low, then yeah, I think the table's set. I mean, don't forget, Matt, that VCs need exits and investment banks need fees, right? And there's, I call it sort of like the VC banker industrial complex, if you will. So when the macro conditions, get, pale green light, as they just have been over the last 4 weeks, that's going to set the table for more and more companies, to go public, because there's a lot of people, whether it's the management, the VCs, private economy, or the bankers who are all incentivized, to do that. And it's a very healthy part of the, broader, economic system that we live in, to have this capital.
Well, what are the risks?
New capital come in and recycled.
Michael, I mean, as Sonali was saying it, I just realized, oh yeah, the Fed, on the same day as an IPO, is that, risky? They have to start trading before 2, I guess, which these days isn't exactly a sure thing. And you've got the bigger looming risks of a government shutdown that's almost guaranteed to happen, and a UAW strike that looks like it's going to stretch out. So could that, ruin the party?
Well, let me take those one at a time. Look, in terms of the Fed Day issue, look, if we were having this conversation a year ago, absolutely, that would be a big issue. But if you actually look at, broader equity market performance on Fed days or CPI days over the last several months, it's not a big thing. It really is not. there. So I think that, the broader complexion is that, are there still, people that want to allocate into this market? And it seems like there are here. And people, IPOs always engender excitement there. Regarding the government shutdown, that, again, is always one of these like sort of perma risk. Unfortunately, it seems to be one of these perma topics that the markets have to contend with, and the markets generally, by and large, tend to work through those. With respect to the UAW, yes, that's another big risk. I'd argue that it's a bit more political than economic or markets right now, although it does speak to this issue we were talking about in the earlier segment on higher labor cost, slowly and steadily coming into the broader economic condition of inflation there. So yeah, the bankers are going to say, look, things are pretty good. September, the market's supposed to be volatile. It's only down 1.5% month to date.
But it looks okay
here.
But it looks okay so far. Michael, I got to wrap you up there. Unfortunately, Michael Purvis from Talbacken, appreciate you joining us, talking about the IPO market. We are going to talk when we come back about the market-moving events you need to be watching. We're going to give you your trading diary next. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
This is Bloomberg's The Open. I'm Matt Miller in for John Farrow. Time now for the Trading Diary, what you need to be watching this week. We get, you may have heard, a Fed rate decision at 2 p.m. Eastern. Chair Powell's news conference coming at 2:30 p.m. The BOE announces its own rate decision tomorrow. Plus, we'll get U.S. jobless claims and existing home sales on Thursday. Finally, on Friday, a BOJ rate decision that I'm told is going to be fascinating. A special programming note, make sure to tune in for Bloomberg's The Fed Decides. John Farrow, Tom Keene, Lisa Abramowitz count us down to the latest rate decision and Chair Powell's news conference. That coverage kicks off at 1:30 Eastern Time. This was the countdown to the open. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. Coming up, we talk a lot about that revenge travel. You know, what's it mean for the airlines, the cruise folks, the casinos, the hotels? Well, we got an expert on that. Jody Laurie, she works at Bloomberg Intelligence. She's a credit analyst. She covers all that stuff, and she'll give us the latest on how that's playing out. Jeff Chamberlain, CEO at Volta, joins to discuss EV battery development. That's going to be a gating issue, a lot of people think, about the adoption of electric vehicles. And Danielle DiMartino Booth, Chief Strategist and CEO at QI Research. She'll be in studio telling us what we should be listening for with this Federal Reserve this afternoon. Let's kick this whole thing off with John Tucker and get a Bloomberg Business Flash.
All right, Matt and Paul, the major stock average is higher on this Fed day. S&P 500, 10 of the 11 major industry groups in the green right now. Treasury yields, they pulled back after rates on both the 5 and 10 years hit the highest level since 2007. And then you have Brent crude slipping below $94 per barrel. What to expect for Fed policymakers today? We put that question to Seema Shah at Principal Global Investors.
Generally speaking, we are expecting the economy to slow down. You know, the question of recession is a tough one, but certainly an economic slowdown. We're seeing inflation moving in the right direction, at least for now, especially on the core inflation side. So actually for us, we think it's a pause. We think that rates have peaked.
Well, J.P. Morgan cutting its rating on Dollar General to underweight from neutral, reducing its price target. Shares were down about 2%. And just a day after went public in one of the biggest U.S. listings, Instacart's debut rally. A bit of a fizzle today, down about 5%. Overall, S&P 500 down 16 points. The Dow, up 16 points. Dow Jones Industrial Average up 166 points. The NASDAQ 100 right now 39 points higher. And oh my gosh, Justin Timberlake and Tiger Woods teaming up to open a sports bar, opening, it's on 7 East 42nd Street.
Nice.
This thing is like the entire block. It's gigantic. T Squared, a nod to their names, I guess. It's going to have it does have 4 golf simulators, I don't know what duck pin bowling is, dining areas, 35 TVs, including one that's 200 inches. I'm tempted to go in there and change the channel to Bloomberg TV.
It sounds like a
See what
Dave
kind
and
of
Buster's.
reaction.
I was excited for a second because I thought it'd be a cool kind of high-end place to hang out, but in Times Square.
Right? Times Square? Right?
It's at 42nd
Are they taking
Street.
over Jimmy Buffett's hotel? I mean,
I don't know.
These businesses, Times Square is where big businesses go to die.
I don't know. I mean, the tourists are back big time.
Well, it's like in
Europeans
between Bryant Park and Grand Central, we'll say.
It didn't help Margaritaville, dude. Is
that was bad capital structure.
Shrimp dump
It
still
was
over
a
there?
bad capital structure there. I don't know anything about the restaurant business, but I knew that was a bad capital structure.
That's our review, I guess.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming live here on that YouTube thing, so head over to youtube.com and search Bloomberg Radio. That's where you'll find us here. Looking at the markets, as John was just reporting, we got some green on the screen. How about that? We've got yet another IPO. We need to follow up on how the other ones are performing. Let's check in with Bailey Lipschultz. He covers all the equity markets for Bloomberg News. He joins us here in our Bloomberg Interactive Broker Studio. Bailey, what are you looking at?
Yeah, so expectations ahead of that IPO. Klaviyo will be the next one. This is a SaaS company. This is a company that fits into...
No one actually knows what Klaviyo does. Oh, let's not even bother trying to figure
marketing
it out.
technology. They're VC backed. There's a lot of excitement. This is the deal.
I heard something about back-end APIs, and then my eyes glazed over, and I thought...
But regardless, they priced their IPO above a marketed range that they already raised. So being a bit bold, whereas we saw Instacart and Arm maybe pricing theirs a bit more modestly, all eyes will be on with where the marketing and data automation company indicated where it opens at. This is coming in the wake of Instacart yesterday. The stock is down 6.4% this morning, giving back about half of the gains from yesterday. The big thing is this is an IPO priced at $30, opened to 40% above, drifted lower throughout the session on Tuesday, trading lower again today. Whether or not it breaks below that $30 IPO price will be closely watched, but it does seem like a lot of the excitement that initially was spurred by that open, at least as it relates to Instacart, seems to be fading.
All right, so I mean, the good news is we're getting deals done. Okay, the market's open, they're getting done. I don't know about this whole anchor shareholder thing. We didn't do that back in my day. I mean, you just make your 500 phone calls. You give Fidelity the number one allocation by a factor of 2 back in the day, and then you go from there.
Yeah, I mean, we're seeing the risks play out when you have investors buying up a large chunk of the IPO because liquidity is not as big as it would normally be seen. If you're floating half of what you normally would in terms of the initial public offering, you're already assigning a chunk of that to investors who, at least on paper, aren't going to sell. You do see stocks fading. And that's why when you look at ARM, yes, it did pop 25% day one. It's down 17% over the last 4 days. So it's still above that IPO price. But both of these deals, when you're looking at expectations, days 2 through 6 weeks out, they aren't really living up to what many were talking up.
No, and by the way, Klaviyo is starting trading today, but the Fed is meeting at and releasing its a decision at 2. So we've been seeing these IPOs go later and later and later, right, Paul?
Yes.
When you were a kid on Wall Street, it was like 10:30, 11 o'clock. And now it's like 1 p.m. They got to be very careful, right, Bailey? They don't want to start trading
anywhere close to that.
Yeah,
right.
Yeah, no, exactly. And when you look at when they've opened, so Instacart opened at 12:50, ARM at 12:10. So you're kind of narrowing that window between when you'll start trading, and this is going to be the one of the 3 on NYSE. So a bit of a different environment, but to your point,
different than because the others were Nasdaq.
Right? Exactly,
yeah.
And that's kind of a different process in terms of how they're opened. But that's a great point, Matt. When you look at it, all eyes are going to be on the Fed. So if you open this thing at 1:15, you've got the attention of investors for 35 minutes before they pivot to getting ready for those Fed trades.
All right. What's the market kind of positioning here for the Fed, do you think? I mean, is it just kind of, here we got a little bit of green on the screen today, but doesn't feel like anybody wants to go out there and be a hero.
It feels like cautious optimism. When you're looking at volumes on a 100-day, that AVAT function comparing volume at this point in time over the last 100 days. I prefer to use 100 days. It gives you a bit more, maybe 30, but
okay.
100 days is 25% below what's been seen. You toggle that to 30 days, 14% below what's been seen in the first 37 minutes of trading. All eyes are going to be on what comes with the commentary. Are we going to get another hike? But it does seem like cautious optimism without really pushing back into some of those big tech names.
All right, Bailey, thanks so much. We appreciate it. Bailey,
do you follow, by the way, Eddie Elfenbein on Twitter? Do you follow Eddie Elfenbein on Twitter?
No.
I don't really use Twitter very much.
It's X.
But I happen to, sorry, X. Do you follow
Formerly
Eddie
known
Elfenbein on, I'm not going to say that. He has come out with some banger stats lately, which I just wanted to share with Bailey before you go back to your desk on the news side. Since May 1896, the Dow Jones Industrial Average has gained 82,047% on the 1st through the 6th day of each month. On the 7th through the 31st day, it's lost 1.44%.
Fascinating. Yeah. So you're saying you're buying into the start of a month and selling after week one.
I mean, I just think it's an unbelievable stat, but I trust Eddie.
Who is it?
You know,
of course, begs a question.
He runs an ETF, among other things. He has a very popular blog as well, but I just thought that was a weird stat. By the way, over the last 9 years, the S&P 500 total return index is up 165%.
Yeah.
Meanwhile, Paul, Disney is down 1%.
I know. You got to be in the market, as Tom says. The courage to be in the market. So
the courage to invest. Sorry, I didn't mean to keep you, Bailey. You can go back to your...
Get back to your real job. We appreciate it, Bailey Lipschultz. All right, Jody Laurie. I found out she was going to be in New York today.
She's not on a cruise?
She's not on a cruise.
She's not in a casino somewhere?
No, which that actually would count as like a business trip for her.
Yeah.
So Jody Laurie's in New York, so we grab her because she's usually based out of Princeton.
How many chips, Jody, can you buy on the Amex, on the company Amex?
So you go to a casino doing some primary research.
Is there a limit? Does BI have a limit on the chips you can buy?
Well, Jody, no, but for others, yes.
Yeah.
No comment to
that.
No comment. So you cover the credit side of this business.
I do.
And is that better than the equity side? I always wonder, is one better than the other?
They're big
in terms of
issuers.
investment?
I mean, I would argue that the credit side is always the correct side. If you're not going to do well on the credit, then you won't do well on the equity.
Equity is soft. Credit is hard, is what the kids say.
Yeah.
Yep, that's only. All right, Jody, you're at Bloomberg Intelligence. As Matt said, you cover the credit side of all that consumer stuff here. And I guess your companies, I remember the early days of the pandemic, one of the first capital markets moves was the cruise ships issuing debt because they knew they weren't sailing anywhere. And they had to fortify their balance sheets.
And double-digit coupons, right?
Yes.
I mean, I remember you could get 11 or 12% on that debt.
So let's start with the cruise lines. How are those bonds doing? How's their business doing?
So the cruise lines are actually companies that we've become a little bit more optimistic on. Now, saying optimistic is a little bit iffy when you're a bond analyst, but that said, in the grand scheme of things, they've been really doing great in terms of advanced bookings, in terms of just getting people back out there and really engaging their customer base as well as broadening their customer base. And that's what we're seeing this year, the momentum that's building, the ability to pay back their debt. They're doing it much more aggressively than we anticipated, and I think that's just going to continue into 2024.
So did they refinance some of those early bonds that they issued?
They did refinance some of them. Carnival got into a little bit of... they got a little bit of a backlash because they did do some double digits since the pandemic, but they've really been focusing on bringing down the debt load and also attacking those double digit coupons as much as possible.
You know, I know you've got a focus idea after the cruise lines versus the theme parks, and it's perfect timing because what did we see yesterday? Disney said they're going to double their investment in their theme parks, so I think $60 billion over 10 years. I love that because I know the returns there are awesome. People go to these parks. How do you think about the parks versus the cruise lines from a credit perspective?
Sure, and my colleague Steve Flynn, actually, he alerted me to it because he covers Disney since it's much more a media company, although I said to him, at what point does it become more of a leisure company and then it becomes my company?
That's right.
When they're selling off some of their media, focusing fully on their entertainment business. I mean, one could argue I should cover Disney.
I'd referee that fight. Yeah. That's what analysts do. They fight over the card.
Yeah, no, I yield to Steve.
Reporters
he knows that
do
name.
That too.
Do they?
Yeah, of course. That's my beat.
Okay, good. Auto.
Yeah, so it is an interesting time because Steve did tell me that they are increasing their cruises as well.
Yep.
And if you look at a name like Marriott that's just gotten into the cruises with their, really elite sort of smaller ships, that they're also investing a little bit more in cruises. So it's definitely an area that people want to go into. For the theme parks, it's a little bit interesting because last year we saw record attendance. We saw this tremendous influx of people going to theme parks in the US. And if you look at, so the terminal now has something called Alt-D data, so that's ALTD. And Alt-D is basically, it's our Bloomberg second measure data. It's data that folds in basically credit card swipes and identifies people in terms of where they're spending, where they're going and spending their time. The fantastic thing of Alt-D data is that you can actually look at the cruise lines and the theme parks and sort of see this trend analysis. And something that we've been noticing, and it sort of fits with our narrative, yeah, it's really great stuff, is that the theme parks have not been as sought after this year as they were last year. Now, last year we were pretty optimistic about theme parks. We thought that they're doing great. The story of the credit quality improvement has sort of run its course. And now they're sort of looking for next steps, and it becomes a company by company basis as opposed to, buy the whole sector type of situation. We don't say buy, obviously, but.
Right. I wonder about why obviously? Why don't you say buy obviously?
We don't have ratings at Bloomberg Intelligence. Who cares about ratings?
But do you make decisions? Because I've heard that, so someone's just writing in and saying he loved the BI write-up on Birkenstock, saying BI, great feature, super helpful. In the past, though, I've heard people say, do they ever tell us anything? I mean, is it?
I'd argue we tell them a lot.
So beyond, but you don't say like, I like this, I don't like this.
Well, we will say in the context of directionally, right? Relative value. So, for example, with our focus idea, we're saying we think the cruise line debt is going to tighten versus theme park debt. So we think the yield or the spread is going to be tighter than theme parks, and we think that's going to happen over the next 6 months.
But what about recommending? Because Paul and I have been looking for a cruise to take, and I know that the sort of Lindblad, you mentioned Marriott, right? Smaller, more elite. Lindblad is one that I've actually done. It's amazing. They're tiny but expensive. The same is true of Viking.
Yes.
But in terms of the big, like opiate of the masses, like Wally cruise lines, right? Is Disney differentiated? Because I met a very wealthy couple. They have their own plane. Yeah. And they were taking, and they have no kids, they were taking a Disney cruise from like LA to Tokyo.
Yeah, we took a Disney cruise in last month.
Really?
Yeah.
So is it kind of a step above the other, princess cruise lines?
It's different. So it does have a more family-oriented feel to it. I think some of the cruise lines have moved in that direction since Disney got into the cruise ship space and they saw that there was an opportunity there. I think what makes Disney different, and this is where I was trying to sort of get under the surface a little bit, and Steve said that they don't necessarily disclose this information because it's Disney, but when you look at cruise lines, something that you care about is something called occupancy rate. Now, occupancy rate is 100% if you have 2 people in a cabin per cabin in the cruise ship, right? So they usually average, so if you're talking Norwegian, Carnival, Royal Caribbean, they average at somewhere in like the 108, 110, sometimes a little bit higher. So you have 2 or more people in each cabin. Now, Disney, I can tell you just from anecdotal. Now, anecdotal is not something that you go by when you're an analyst.
This is what we're asking, though.
Of course, anecdotally, they have to be running 150%, I would think. And this is my non-analyst view, my anecdotal view. I couch that as something that I don't know. I don't.
So because there were kids crowded into your room.
But yeah, I mean, if you look at, for instance, my family. So it was my parents, some of my siblings, and my kids. So we had, in 2 of the rooms, we had 4 people in each of the rooms, right? And then one of the rooms, we had 3 people in each of the rooms. So, I mean, you had 3 rooms there with almost 4 people in each room.
I mean, Jody, we love you and your family, but you're not selling us. You're not selling me and Paul on this.
Yeah, I mean, I think,
we're looking for mimosas.
I don't want to be on deck with a bunch of screaming brats, right? I want to have a nice, luxurious, pampering experience.
Sure, and
I've heard Disney is like high end in terms of the service.
They do offer the opportunity to go to a different part of the ship that is adult only. Right. And I did get to sneak off into that area a few times. It was pretty nice. It was pretty quiet, pretty isolated. We actually ran into some of the babysitters who were babysitting my twins. They're late at night, so it was pretty funny that way. But I think for the cruise lines, people get very personal about what they recommend, and they get very loyal to the brands. And I think that's something that's key. Is a lot of the cruise lines are trying to lock that in, and they're trying to get more people to become loyal.
My twins are 27, by the way. It happens. Jody Laurie, thanks for joining us. Jody Laurie, Bloomberg Intelligence Senior Credit Analyst. She covers all the leisure stuff and all the fun industries. You know, she's not doing like Caterpillar or any of those kind
Caterpillar's fun?
Yeah, it's not as fun as going on a cruise, though. That is fun. S&P 500 up fractionally. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Goldman Sachs is in advanced talks to sell its Green Sky unit less than 2 years after it bought the business. The buyers include Sixth Street Partners, KKR, and PIMCO. Bloomberg Sonali Basak says there's an irony in the proposed sale.
Remember, Sixth Street as well has a lot of Goldman alumni on its own. It has Marty Chavez, the former CFO, Alan Waxman, and it is bringing on Julian Salisbury as well. So a homecoming of sorts. But remember, there is a price for everything. According to the Wall Street Journal, this deal may be around $500 million, a far cry from the $1.7 billion Green Sky was acquired for.
Now, shares of Goldman right now, they are down just about 0.2%. Instacart is falling after going public in one of this year's biggest U.S. listings, and it already received a lukewarm hold rating from Needham. Bloomberg's Abigail Doolittle says it's a trend.
We saw that last week with ARM. ARM closed up 24% on its first trading day, and then the 3 subsequent days, not counting today, last time I looked, it was about flat, down 4 to 5%. So this is a lot different than some of the pandemic darling IPOs that we saw, such as Airbnb up 113%, Bumble up 64%, Affirm up 98%, Poshmark up 142%. This is positive, but when we put it into the perspective of when the IPO market was truly healthy, we still don't know.
Now, Instacart right now down about 4.5%. Checking with ARM right now, it's down nearly 5%. And today, Klaviyo makes its trading debut. The data automation firm priced its IPO above a marketed range to raise $576 million. Now, yesterday, the company and a group of investors sold 19.2 million shares for $30 each. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, seeing some small moves in stocks. It looks like we're treading water ahead of 2 o'clock Wall Street time. Treasury 2-year yields, which are more sensitive to imminent Fed moves, halting a 4-day advance. Traders are looking ahead to this afternoon. Fed expected to hold for the second time this year following a slowdown in inflation while leaving the door open for another increase as early as the November meeting. Oil right now dropping following the rally that briefly sent Brent above $95 a barrel. That spurred some inflation concerns. Right now, the S&P 500, 8 points higher. That's up 0.2%. 44.51 on the index. The Dow Jones Industrial Average is up 140 points. That's a rise of 0.4%. The NASDAQ 100, that is now down 10 points, down about 0.1%. 2-year yield, 3 basis points lower, 505. The 10-year, 3 basis points lower at 432. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. We're streaming on YouTube, so check us out there, youtube.com, and search Bloomberg Radio. All right, Matt, we're going to electric vehicles, Matt. It's happening. I mean, you were so kind to fire me up with with the Ford F-150. That was awesome. But I'm not going there unless there's the batteries are better in the charging stations everywhere. We got gas stations. I'm not going to be a first adopter.
There are a number of reasons.
I'm not going to be a first adopter there.
Tentative about it.
Yes, call it that.
But, sorry, my mic was off. Thank you, Ken.
Yeah.
There are a number of reasons to be tentative about it, but how fun was it to drive the F-150 Lightning?
Yeah, it's a beast. I have to admit that was pretty cool. Jeff Chamberlain joins us. He's the CEO of Volta Energy Technologies. He joins us live here on our Bloomberg Interactive Broker studio. Appreciate that. See, when it's Climate Week, you get people coming into New York. When it's UN Week, people come into New York. You get them in studio. Jeff, tell us about your company, Volta Energy Technologies. What do you guys do here in this EV space?
We invest in battery and associated technologies, including the kind of infrastructure you were talking about, charging stations, et cetera. There's a whole bunch of new technology requirements there that will be and are being adopted. And so our whole goal is to invest in companies at that inflection point when they come out of science and they're all ready for scale. And we're industrialists and we're investors by training and by experience. And ultimately, I ran all the battery work at Argonne National Laboratory for 10 years. Got to see supply chains developing around the entire world and what the customers' needs were, so that we believe we can place capital more effectively than most.
So unlike Paul, I am there. I'm ready. And I've got my eye on a few EVs that I think are just amazing in terms of the powertrain. And my one concern is that I buy something and it becomes obsolete by the time it gets delivered. Do you see the same kind of, what's it called, Moore's Law, in batteries that we famously saw in chips? Do they just double in capacity every year or halve in price?
Yeah, thanks for the question, Matt. And by the way, thanks for having me on. I appreciate it.
Sure.
I come from the chip industry, and so we have tried to design or declare what a Moore's Law looks like. But no, in Moore's Law, it's double the density of transistors on a wafer every 12 to 18 months. What's happened in the battery industry is they were first commercialized, lithium-ion batteries were first commercialized in 1992 for camcorders. So 30 years have progressed. The average is something like in the low single digits, maybe low double digits, percentage improvements year over year, as opposed to a doubling. So there is a kind of Moore's Law for battery, but it's not as extreme as what you're describing. But I do want to say one thing. In 2004, when Tesla started, the battery cost, the unit of merit is dollars per kilowatt hour. They were at about $4,000 to $6,000 per kilowatt hour. Parity with gas-powered vehicles, you need to be about $100 to $150 a kilowatt hour. So they had the hubris to believe economies of scale and better engineering could get you there, and guess what? It did. The costs are down over 95% since they were very close to parity with gas.
So what are we looking at now per kilowatt hour?
It's depending on the supplier. It ranges between $80 and $180 a kilowatt hour. So we're essentially there.
Okay, because the ones I like, well, GM has these massive 210 kilowatt hour battery packs. I don't know how efficient they are, but I just it's like a big block V8, in the truck. They get 450 miles of range. The new Escalade EQ, I think it's called, or Escalade IQ, I can't remember. Anyway, the new EV Escalade does 0 to 60 in 5 seconds, and it weighs damn near 10,000 pounds. It's just unbelievable the amount of thrust you get from these electric motors. What do you think about the obsolescence of the battery, though, over a few years? Like, you can't just swap out a battery from these the way you could with an ICE engine.
You can swap them out. I mean, you could if you wanted to keep your truck and put a more modern battery in it. There are ways to do that. But my guess is it'll be less costly for you as a consumer to buy a new vehicle. I don't think obsolescence is going to move that quickly in the battery tech. The key that they're aiming for is cost and range today. But there's another key that Paul mentioned, and that's the infrastructure surrounding it. Where can I go to charge my vehicle quickly? What is potentially more important than range is ubiquitous fast charging. Can I fill my vehicle with energy to go 300, 400, 500 miles in 5 to 20 minutes? That technology is on the rise. It's being adopted right now.
What do we know at this stage of development of the EVs and batteries about the supply chain, the raw materials needed? I've heard from some people that that's going to be a gating issue. What do you know about that from your
there's a lot of folks out there that talk about lithium being a resource. Lithium is the key. Let's start there. Okay. In fact, I was hoping to talk today about a comparison with oil. The last time the human race has experienced an energy transition like the one that has started was a shift from whale oil to rock oil. And this transition is on the scale of that transition. By rock oil, I mean petroleum.
I mean, you got a PhD in
what, the shift from oil
from whale oil, which
but now what's comparable now to the shift from oil?
The shift from oil to renewable power and electric transportation is on par in terms of the size of the shift and the overall impacts on a wide variety of industries, as oil was. Oil was started for lanterns.
Right.
Look at where it ended up.
So I'm wondering actually about that in terms of how much lithium there is in the ground, how easy it's going to be. I guess it's going to get easier and easier to get it out of the ground. Is it as reliable as oil has been for the last century?
Short answer is yes. I think there's a lot of hand wringers that are telling us there's not enough lithium in there. There's crust. There definitely is. Your point's a good one, though. Some is economic today in terms of extracting and refining it. Some is not. One of the things we invest in, and we're not the only ones, is new technology to make the extraction of lithium more economic. And so that, getting back to the supply chain issue, the headline is China controls a lot of the materials. But in the case of lithium, the vast majority of lithium that's ready to use in batteries comes out of China, but it's processed there. It's not mined there. And this is something I was hoping to talk about, getting back to the supply chain.
Where is it mined?
The primary resource is the so-called cone in South America. Chile has a massive resource, so does Bolivia and Argentina. That's where the biggest resources are. There's some in Australia, there's some in China, there's a lot in the US. And this is really what I'm saying, we're at the early stages of this. It's like finding a new, it started with spindletop, oil did in Texas, then we found oil, humans found oil in Saudi Arabia. This same thing is going to be happening with lithium.
So are you, at Volta, are you investing in, or are you involved in other companies investing in the processing of these materials here? Because we don't want it to all be processed in China.
We absolutely are, including new technologies to process them more efficiently and less costly. So and that is something I want to say, the supply chain movement is evidence of the maturity state of this industry. And what I mean by that is a guy from the chip industry, we'd been preaching to anyone that would listen, investors and the government up in Capitol Hill for 15 years. The supply chains are going to move out of China, and here's why. In the chip industry, it makes sense to have centralized manufacturing. The mass of microchips versus their value is massive compared to their mass. So you can get economies of scale, centralized manufacturing in Taiwan, ship them around the world. You can't do that with the battery technology, and you don't have to look any further than the automotive industry itself to believe me. That by units, the largest manufacturer of cars in the U.S. is Toyota. They don't make their cars in Japan for the American customers. It's the same thing with battery tech. Those supply chains are moving right now.
And by the way, in terms of the change in technology, what you're saying reminds me of something that Gary Schilling, who's a famous 86-year-old economist, he tells me when he was a kid, people were wringing their hands and worried that there wasn't enough copper in the Earth's crust for the telecoms industry. And obviously, we've moved on from that point.
Yes, and the fiber, and there's another thing, that there were New York Times articles in the 1930s when the horseless carriage was really taken off, that there's not enough lead in the Earth's crust. And this is an important point as well regarding movement of supply chains. Lead is recycled. Lead acid batteries out of vehicles, it's like 98.7% of those are recycled. The same thing's going to happen here. So we may not have access to cobalt in those batteries that comes out of the Congo, but we will because we're going to move to so-called urban mining, waste materials to get copper, cobalt, lithium, etc.
Fascinating
So
stuff.
cool.
It
Yeah.
is. I mean, I guess you get a bachelor's in chemistry from Wake Forest. What are you going to do with that? So you triple down and you get a PhD in physical chemistry from Georgia Tech. I mean, those are some serious engineering geeks down there in Georgia Tech. So
He means that in a good way.
Yeah, in a good way. Some really big ones. So anyway, then you go into the electric car business. Why not? Jeff Chamberlain, CEO of Volta Energy Technologies. Thanks so much for joining us, coming into the Bloomberg Interactive Brokers studio. So again, it is Climate Week in New York, and so we get a lot of smart people coming through here talking to us about what's happening out there in the evolution of the energy space. S&P 500 up about 0.2%, giving up some of those gains. The Dow's up about 0.5%, but NASDAQ really pretty much unched on the day. Looking at the yield front, yields pulling just slightly. 10-year Treasury off about 3 basis points, 4.33% on a 10-year Treasury. And WTI crude oil off about 0.2%, sitting right at $91 a share, $91 a gallon. So we got that. All right, right now, let's head down to Washington, D.C. Amy Morris has got world and national news.
All right, thank you, Paul. Congress is now 10 days from a government shutdown, and House Speaker Kevin McCarthy's latest plan to avoid one isn't really getting any traction. Bloomberg Government's Jonathan Tamari covers Congress from Washington and brings us the latest.
It looks pretty grim. There's a new plan seemingly every few days, and it quickly comes and goes. So McCarthy's plans are pretty much falling by the wayside. He's got such a slim majority that it only takes 4 or 5 Republicans to sink anything that comes up.
Bloomberg Government's Jonathan Tamari in Washington. Attorney General Merrick Garland is testifying before the House Judiciary Committee today. His appearance comes as judiciary and 2 other committees in the Republican-controlled House are conducting investigations into President Biden and his son, Hunter Biden. Garland is pushing back against claims by some Republicans that his office makes decisions based on political motives. Health experts with the Centers for Disease Control and Prevention are predicting what they are calling a repeat of a triple-demic this fall and in the winter with COVID-19, RSV, and influenza. Corewell Health infectious disease physician Russell Lampin says the COVID-19 vaccine is updated for this fall.
The plan appears to be that there is going to be an annual COVID vaccine available in the fall that's going to, again, best match the circulating strains that are out there.
Dr. Lampin is urging everyone to get their flu vaccinations and the COVID-19 booster before this winter. Hollywood's major studios are set to resume contract talks with the Writers Guild of America today. Now, that strike started in early May. The WGA is encouraging its writers to continue picketing until they can reach an agreement. Writers want higher pay and protections around the use of artificial intelligence. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
John Tucker in the Bloomberg News. With this Bloomberg Business Flash, kind of treading water with equities right now. The S&P 500 does edging higher right now. 9 of the 11 major industry groups, they're up. Real estate, industrials, best performers. You have Amazon and IBM shares among the best individual performers in the index. And then Treasury, 2-year yields halting their 4-day advance. Traders, of course, waiting for the Federal Reserve interest rate decision this afternoon. Paul Donovan at UBS says inflation is down. Policymakers, he says, they should be finished.
Does he really say that?
He said they're finished raising rates, so there you go. S&P 500 right now, 10 points higher. That's up 0.2% at 44.